Yeah, I think we all have to hope that. But there's a fascinating story, a truly fascinating story about what's going on in Turkey and the investment you've made in public health in particular. And once again, thank you for that shipment of PPE over the United States. That is Serdar Kilic. He is Turkey's ambassador to the United States. That's going to do it for Balance of Power for today. You want to stay tuned, though, because we're going to have a special coming up at 2 o'clock Eastern Time. We're going to be covering the FOMC, the Federal Open Market Committee. They're going to be coming out with their decision. We're going to be hearing after that from Chair Powell about exactly what their plans are going forward, what their asset purchase plans are, what they see in the U.S. economy for the second half. That does our Balance of Power. I'm David Weston, and this is Bloomberg Radio.
What do you do to be an everyday superhero, like Mary?
So I know it's tempting to pour used cooking oil straight down the sink, but I spoke to the local council and they said the best way to get rid of oil or fat is to collect it, once it's cooled down, of course, in a used container. And then you can scoop it out and put it in the bin.
Cooking oils and fats block thousands of pipes every year. Save our sewers, rivers and seas by putting them in the bin, where they belong. Visit thameswater.co.uk/bin it. Together, we can care for the environment.
Right now at the Halifax, wherever we're working from,
we're all working together to be there for you.
So our customers can apply for a payment holiday on mortgages, loans or credit cards.
And because we want you to stay home and stay safe,
we've created step-by-step guides to help you set up online and mobile banking,
which is safer and easier than you may think.
But for those that really need to see us in person, we're keeping as many branches open as possible.
So however you need us at the Halifax,
we're here to help. Terms and conditions apply. For more information, go to halifax.co.uk.
They say singing can help you remember things, so here's some tips for parents out there during these tough times.
Number 1.
Make sure your kids wash their hands for 20 seconds after they've coughed or sneezed or been outside.
2.
Virtual play dates, social and physical distancing can help save lives.
3.
Tell them they're safe and show your love and pride. Yes, we'll get through this together. Find out more at coronavirus.gov. A message from the CDC and the Ad Council.
Behind the highlight reels, championship rings, and colossal paychecks, there are sports stories that fuel, deepen, and even challenge our love for the game. For true tales of underdogs, anti-heroes, and game-changing innovators, search sports documentaries on the TuneIn app.
Hey, it's Jacoby here from Jalen and Jacoby, and after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen and Jacoby, The After Show. And we will be joined by the director of the documentary series, Jason Eyre, to discuss each episode in detail. You can hear our After Show right here on ESPN Radio on Sunday nights after the episodes air. And they'll be available on the Jalen and Jacoby podcast feed.
Search Jalen and Jacoby to listen today.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. Bloomberg Business Week, the Fed in focus.
They've really been steadfast about providing the stability that this country needs.
It's not what they do, it's what they say afterwards.
I wouldn't put it past the Fed to do a very quick 180 here.
It's all about the year ahead at the Fed at this point.
The Fed in focus on Bloomberg Radio.
Yes, indeed, everyone. Live from New York and New Jersey, streaming on YouTube. It is Wednesday, Fed Wednesday, April 29th, 2020. And, of course, it is all about the Fed's latest decision. And, of course, we do have some headlines crossing the Bloomberg terminal. The Fed holding rates, saying the virus poses the biggest risks over the, quote, medium term, and also the health crisis to weigh heavily on economic activity. Jason, we're going to be digging into these headlines. And, of course, we have the press conference with the Fed chief.
Well, and we're also going to keep an eye on one of the headlines. They also are citing, said to continue, they're saying they're going to continue Treasury and MBS buying in amounts needed. So that's something that the press and investors are going to hear a lot more about. We're going to dig into it with all of our experts. First, let's get to Charlie Pellet for some market reaction and some business news. Hey, Charlie.
Well, hello there. Let's get right to the numbers. S&P up 78 points, up 2.7%. The Dow up 550, higher by 2.3%. NASDAQ up 299 points, up by 3.5%. The 10-year up 3/32. The yield right now 0.60%. Gold is down 0.1%, 17.05 the ounce. West Texas Intermediate crude, major story today, surging again. Big moves there, lots of volatility with WTI up 25% right now, 15.40 a barrel. That is a gain of just about $3 a barrel on WTI. Again, repeating the headlines out of the Federal Reserve. Yes, we'll have Jay Powell speaking a little later on, bottom of the hour. Fed holding rates steady, saying the virus poses big risks over the medium term. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. The Focus on the Fed, it's brought to you by Commonwealth Financial Network. For the 6th straight time, J.D. Power ranks Commonwealth #1 in independent advisor satisfaction among financial investment firms. Visit commonwealth.com to learn more. Carol, what else are you seeing that we need to bring to the fore here?
Well, some of the headlines, Fed holding the target range for the benchmark rate at 0 to 0.25%. This is what we expected. And I looked at market reaction. I know Charlie went through it. Didn't see a ton, but I think, we know the Fed is going to be, sure and steady. Yeah. There's going to be no surprises because it's not what investors need. It's not what the world needs, and certainly not what the U.S. needs. The Fed does talk about weaker demand, lower oil prices holding down inflation. That's not to be surprising as well. And as you said, continuing what it needs to do to support the liquidity within the system. So that means continued purchases of treasuries, also mortgage-backed securities when needed in amounts that are needed, but on hold until a confident economy is back on track. And that is the question that we've been trying to get from CEOs that we've been talking to, and certainly as we, suss through the earnings reports and figure out what comes next.
Absolutely. All right. Well, let's break it down with our experts. Dave Wilson, stocks editor for Bloomberg, joining us via remote in New Jersey. Kathleen Hayes, global economics and policy editor for Bloomberg, via remote from the Poconos. Kathleen, I want to start with you. What jumped out at you? Nothing, it seems, too shocking here, but what do you see with your expert eye?
Well, this is what was pretty much expected. The Fed has already done so much. Emergency meetings, a dozen almost special lending facilities. There isn't too much they can do now. On top of that, I think that's what a lot of people would say, unless they want to move to negative rates. And every time Jay Powell's asked, chair of the Federal Reserve, he says he doesn't have a great interest in that. They did say in their whole idea of guidance that it will use its tools and act as appropriate to support the economy. There are some people out there, we were talking about this yesterday, who would like to see a more strong commitment to keeping the key rate at 0 until inflation hits 2.5% or unemployment's down to 4%. But it seems that, I think that they feel they have done what they can and what they must for now. They have said, again, they're going to keep the target range for the key rate near 0, quote, until the Fed's confident the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. So don't worry about rate hikes. Jay Powell will get asked this today. He said at the last press conference, he said in these special interviews he's given on NBC and the Brookings Institution that that's a distant goal. Their goal now is to look at the economy, watch the economy. No, they can't cure the virus with any of this, but they can support the economy so that any strains we're seeing don't compound what is already clear to us now is a recession. GDP contracting nearly 4% in the latest quarter, and Bloomberg Economics looking for a record 65% contraction in the second quarter. Right. That the storm is raging, the boat's rocking. We've got Chair Powell steering the boat, and we've got everybody on deck, all those Fed board governors and Fed bank presidents. But all they can do is ride out the storm by trying to steer the boat.
What's interesting is I'm just looking at our Fed Live blog, and as you noted, Kathleen, and others did on the blog, There's no explicit forward guidance in the statement with language about keeping rates on hold until the central bank is confident it's on track to achieve its dual mandate. What's interesting is folks from the outside, George Pirkus over at Bespoke, say this is about as dire as the language the Fed uses that they can get, which may explain, and let's bring Dave Wilson into this. Dave, I've noticed that equities, which have been on a tear and a rally today, taking a little bit of a leg down on these Fed headlines.
Yeah, a little bit, but they'd backed off their high just shortly before the minutes came out, too. So, more of a continuation in that regard. But bear in mind, you're talking about an up day for stocks really being led by some of the more economically sensitive areas of the market, energy companies, raw material producers, the makers of those consumer discretionary products or providers of those services when you think about, retailing and a whole lot of other industries, automakers, home building. So, we're seeing, in a sense, the Fed's judgment in terms of how to deal with the economy as it stands is kind of being ratified, in a sense, by what's been happening in the stock market. And you really go back to the lows last month and see that as well if you look at the top performers among the S&P 500's 11 main industry groups since that index hit bottom in March.
I'd like to throw something in here because this is maybe subtle and not the hugest big, nothing earth-shaking. But, they did say that they're going to continue to buy treasuries and mortgage-backed securities as needed. I think one reason that's also subtly important, particularly if you're an actual bond investor, bond trader, is the Fed's been able to cut back the size of the repo operations, right? Because they stabilized the treasury market. Remember how it was all over the map in February and March, and they took steps and they've calmed that down. So maybe this is just another way of saying, hey, we'll do what we need to do to keep things steady, not have too much volatility, provide the liquidity that is needed to remind people they're there if they need to do more. But if they need to do less, I think everybody should take that as a good sign that the steps they're taking in credit markets with liquidity, et cetera, have been effective.
And so, Dave, I do wonder from an equity perspective, Jay Powell and his team have gotten, at least by the numbers, pretty good reviews from equity investors so far. Would you agree with that? And do you feel like equity investors feel like the Fed's on their side here?
Well, you just look at the magnitude of the recovery from last month's lows, you can draw that conclusion. The S&P 500 is up more than 30%, which is not shabby. Clearly not back to the highs that we saw a couple of months ago. Nonetheless, if you just look at it from that perspective and then you look at how we've gotten there, that some of the more economically sensitive areas of the market have been leading the way, you can certainly draw the conclusion that the policy moves that have been made are going over well.
Yeah, absolutely. Just taking a look, the NASDAQ now with a gain of more than 3% today, if that holds, the NASDAQ will be down less than 1% on the year, Carol.
And more that Russell 2000 index up more than 5% today, heading for its sixth straight gain of 1% or more. According to the folks at Bespoke Investment Group, that would match the longest streak in the history of the Russell.
And interesting to see those small caps. Kathleen Hayes, what do you want to hear from Jay Powell? What would be your question to Jay at this point? Oh, boy. That is a good question, Carol, because, we know that we're going to get hit now with all the most terrible numbers we can possibly get. Just how many jobs will we have lost a week from this Friday when the jobs report comes out, right? We've already seen the claims go up, some 25, 26 million. So we know that's going to be a dastardly number. And yet, as you guys point out, look how well stocks are doing. You wonder how much is this priced in. Now, good news potentially for the economy. We've still got the 10-year around 0.6. We've still got the 30-year around 1.2. So yes, yields are low. For Jay Powell, boy, oh boy, I guess maybe I'd want to say something like, okay, how much will policy now be guided by what you see happening with the virus? Those news headlines, what developments occur, how the deaths look, how the new infections look, versus what you see in the economy. Is what happens with the virus going to lead your sense, because it's getting better, and we can, and so the economy can get better. Is that going to lead policy? You're going to wait for the numbers to pick up. And besides that, or I'd say something about reopenings. You're an economist, you're the head of the Fed, people, there's all these regions now that want to get back to business. if you look at this as an economist, as a policymaker on monetary policy and financial stability, how does that guide? What do you see? Do he might want to sidestep anything about reopening because it's been so politicized. Yeah. But I'd love to know what he really thinks about that.
Yeah. I think we all would, for sure. Yeah, that's a good line of questioning for sure. We'll see if the reporters put that to Chair Powell. Kathleen Hayes, thank you so much, Global Economics and Policy Editor for Bloomberg, joining us from the Poconos. And Dave Wilson, Stocks Editor, author of the Chart and Stock of the Day. He'll be back a little bit later on with those two features. He joined us from New Jersey, Carol.
All right, let's get back to the markets. Take a look at how the markets are reacting to the Fed move and the headlines. Here is Charlie Pellet.
Hi, thank you very much. We are down since that Fed announcement. Let's recap the Federal Reserve today, leaving rates unchanged, and also says the health crisis will weigh heavily on economic activity. That from the Federal Reserve roughly 11 minutes ago. So here's where we stand in terms of the numbers. The S&P is up 72 now, off session highs up 2.5%. The Dow up 500 points. That's a gain of 2.1%. NASDAQ up 286, higher by 3.3%. And as Jason pointed out, worth mentioning that NASDAQ in the year-to-date column is now down by 0.9%. 10-year yield 0.61%. Gold, a little change now, down $5 the ounce at $17.02. West Texas Intermediate crude surging 24%, up $2.93 a barrel to $15.26. Recapping, S&P up by 71. That's a gain of 2.5%. Now, let's take a look at world and national news. Here's Bob Moon.
Charlie, thank you. There is, for the first time, proof that a drug can block the coronavirus. So says the nation's leading infectious disease expert. As Bloomberg's Irv Chapman reports, Gilead Sciences' experimental drug could become the first effective treatment.
The finding was welcomed by the director of the National Infectious Diseases Institute, Dr. Anthony Fauci, speaking at the White House.
The data shows that remdesivir has a clear-cut, significant positive effect in diminishing the time to recovery. This is highly significant. If you look at the time to recovery being shorter in the remdesivir arm, it was 11 days compared to 15 days.
Dr. Fauci said he spoke out now because patients who were receiving a useless drug as part of the controlled study could immediately be switched to the real thing. In Washington, Irv Chapman, Bloomberg Radio.
An impassioned condemnation today of Republican complaints that so-called blue states are expecting other states to bail out their economies. New York Governor Andrew Cuomo calls it ugly.
Senator Scott from Florida says we're supposed to bail them out. We versus them. It's we and it's them. That's not right. Who is we and who is them? Them, the people who had coronavirus. They are the ones who had the coronavirus. We, without the virus, are supposed to bail out those people who have the virus. What an ugly sentiment.
In reality, Cuomo says New York pays much more to the U.S. Treasury, effectively bailing out many other states every year. Global News 24 hours a day, on air and on Quick Take by Bloomberg. Jason Carroll, back to you.
All right, Bob, thank you so much. Well, you are listening to special coverage of the Fed decision. This has been long awaited in some ways, or heavily anticipated, although we sort of knew what they were going to say. Yeah. But the Fed has been, maybe it's better to say, so closely watched throughout all of this, Carol. And I think what we're really waiting to hear is what Jay Powell says.
Yeah, exactly. And I thought Kathleen, her questions, her suggested questions that she would ask Jay Powell were spot on in terms of policy being guided by the virus versus what he is seeing in the economy. So let's get into this. Lindsay Piegza is back with us, chief economist at Stifel Financial, on the phone from Minneapolis, Minnesota. Lindsay, so glad you could join us again. I hope you're doing okay during all of this shutdown. Tell us a little bit about the headlines and what we heard from the Fed so far.
Well, from a policy perspective, it was pretty much as expected. The Federal Reserve leaving everything unchanged. No change in rates, no change in QE, no additional liquidity programs announced. But to be fair, the Fed is already committed to essentially pulling out all this stuff. So this was as expected. What we really want to know going forward is the Fed's assessment of how these initiatives are succeeding in stabilizing the market and more broadly the economy going forward, and really painting a clearer picture of what they expect in the second half of the year, assuming that we are able to reopen the economy and get workers back into a position of employment.
So, Lindsay, as you look back over the past few weeks, which to all of us probably feel like a few months or a few years, what are the key moments from the Fed's timeline and the Fed's perspective as you look at it as an economist? What were the key moves that were right, and what were, the key moves where you thought, maybe they could have done better?
Well, I think it's a little too early to assess what was right and what was wrong. We don't have the hindsight quite yet. I think at this point the Fed should be applauded for getting out ahead of the curve. We know they did a number of unexpected moves, preemptive ahead of those pre-scheduled FOMC meetings. And I think that in and of itself says that the Fed was willing and able to take those needed steps to stabilize the market beyond what we saw from other central banks around the world, and beyond even what we saw from the playbook of the 2007-2008 financial crisis. So from that alone, the speed and immediacy in which these policies were implemented, the Fed should be getting a very above passing grade for sure.
Lindsay, one thing that I thought was really spot on, Kathleen Hayes, who follows the Fed so closely for us here at Bloomberg News, talks to all of the Fed bank heads, said one of the things that's on her mind is how will policy be guided by the virus versus what Jay Powell and company are seeing in the economy. And I do wonder what you think about that and what they should be focusing on.
Well, it's interesting because remember, going into 2020, the economy was already losing significant momentum. The consumer was cut in half, down from a 4% contribution to 2% contribution. So the consumer was already very clearly waving a red flag that there was not enough momentum to carry forward even this pre-virus trend pace of 2%. Rates were at historically low levels. So the Fed was already struggling with how to perpetuate the longest expansion in history as the economy began to lose momentum. So at this point, you layer on the pandemic, and it's going to be very difficult for them to parse through the impact of the virus from the impact of a slowing economy that was already well embedded heading into the pandemic.
And so, Lindsay, how do you parse that? That's sort of your job, too, for better or worse, is, sort of stripping that out. What tools do you use and what do you come up with when you try and discern that?
Well, essentially, at this point, we know that the Fed is going to be perpetually on the sideline. Rates are going to be benchmarked to zero for essentially as far as the eye can see. The Fed saying today in the statement until they feel comfortable. But again, that goes beyond the comfortability with controlling the health ramifications in terms of the comfortability of the economy getting back on track. And I do think there's going to be some longer-term lasting consequences for the potential productive level of the U.S. economy, meaning even after we see workers go back to work, patterns of consumers have already changed. Right. We're not going to see immediately restaurants refilled, movie theaters refilled. And it's likely that we're unable to reach even a 2% growth rate 12 to 18 months from now. So the Fed is going to have to continue to provide accommodation beyond what we would have expected, even independent of the pandemic.
I think, and we feel that way too, I think, from some of the conversations we've been having from CEOs running companies, Lindsay, is that people are really nervous about what the other side looks like. And it's not so easy to bounce back and necessarily rehire all those people who lose jobs, especially if economic momentum is subpar and certainly not what it was pre-virus, right? So how long do you think we see a downturn?
Well, I think it's going to take some time for businesses to reconnect to workers. I think it's going to take time to reconnect to supply chains. And on the consumer side, as I mentioned, consumers are going to be very hesitant based on lingering concerns from the virus, but also very much a depleted financial situation. So I do think that we're going to see the hardest hit with the GDP down 30% in the second quarter. That's by far the worst, and we can move beyond that in the second half of the year. But getting back into meager territory of positive 1% growth is likely the best that we can ask for throughout 2021.
Well, and Lindsay, it's always good to talk to folks who are not, here in New York City or on one of the coasts. And I do wonder what the recovery looks like where you are there in Minneapolis and how you and your team look at this. obviously we're talking about the U.S. economy in aggregate, but this is an economy that feels like it's going to get only more complicated to try and model and to try and predict, given maybe the unevenness of both sectors and geographies across the country.
Absolutely. The recovery is going to be very much segmented from state to state and even within the state, local community to local community. And what we're seeing up here in the northern Midwest is the number of cases is exponentially lower compared to what you're seeing in New York, yet the level of fear and concern is arguably just as high. And we see the precautions and the behavioral changes just as you would in New York City, even though we have 1/10, I think it is, of the cases in the Midwest.
Lindsay, right. And I am thinking a lot about, especially hearing kind of the impassioned conversations and speeches and updates that we're getting from Governor Cuomo about the cities that are so crucial to country momentum here in the United States, whether it's California or New York, that if they are in fiscal and financial troubles, how that creates a longer downturn for the nation overall.
Well, we have to be a little careful when we talk about the fiscal restraints of state and local governments, because many were facing these financial hardships prior to the pandemic. So again, we have to separate what they were facing and now the additional hardship becomes the virus. Absolutely, we want to help out our fellow states and our fellow Americans with national funds to help stem the spread of the virus, but we don't want to be taking taxpayer dollars to bail out mismanagement of state and local pension, securities, you name it. So there does have to be a lot of oversight on where these funds are going, and we have to be able to draw the line and say some state and local governments are going to feel disproportionate pain because going into the virus, they did, as I said, have a mismanagement of their fiscal books.
Well, and I do wonder as well, Lindsay, as we think about the states, we think about the localities. I just want to go back to something that you said briefly about economic behavior and consumer behavior. We talk about the shape of the recovery, but what if the other, sort of part of the V is not as tall? If you get my, it bounces back, but it doesn't bounce back anywhere close to where we were before. How much do you worry about that?
Oh, absolutely. And like I said, I do think that we get back into positive territory, which is the silver lining here by 2021. But it's not going to be the 2%, 3%, 4% growth that I think a lot of economists are hoping for as we revert back to, quote, normal. I think the assumption that we get back to normal anytime soon is very aggressive. To say the least.
Yeah.
So I do think an anemic growth profile as consumers are perpetually limiting, changing, altering how we spend and how we interact with other individuals is maybe not a permanent change, but certainly an alteration that we see in the near to medium term.
Yeah, almost like a reverse check mark shape.
Right. All right. Lindsay, thank you so much. Really appreciate your insight and always being there for us. Lindsay Pieggs, she's Chief Economist at Stifel Financial. Stay safe on the phone from Minneapolis, Minnesota. Also always there for us, Jason, Dr. Stephen Skanke.
Love catching up with him. So glad he was able to make some time for us today. Chief Economic Advisor at Keel Point, of course, former U.S. Treasury and White House National Security Council staff member on the phone from lovely Cape Canaveral, Florida. All right, Dr. Skanke, great to be with you here ahead of Jay Powell. We're going to hear from him at the bottom of the hour. What jumped out at you from this report, from this statement from the Fed that was largely anticipated? What do you need to hear next?
The report was really not surprising at all. They could have announced something in particular, but I think it would have diminished its importance in that they've used emergency meetings and emergency announcements to telegraph their focus on particular issues. For them to say that they're keeping interest rates where they have been is totally as expected. For them not to have highlighted or called out any of the 11 emergency facilities that they've announced also makes sense. They're wanting to watch and see what happens next and not be part of the calculus today. And I think that's exactly what they've done. They've come in a proactive, preemptive way that while there will always be second guessing as we get down the way on this, and obviously they're there are some concerns and issues that will be discussed for a long time to come, but they seem to have had about the right mix in the way they've weighed in, and not getting too specific today on new things, I think, is a way of keeping what they've done to date really the central focus.
And I want to ask you something about, because Kathleen Hayes, who covers the Fed for us at Bloomberg, brought up a great question about whether the Fed should be focusing on what's going on with the virus versus what's going on in the economy. Having said that, a headline crossing the Bloomberg about remdesivir, the Gilead drug that we've all been focusing on today, remdesivir emergency authorization planned as soon as Wednesday. This is according to the New York Times, and that emergency use authorization is when the government basically says we're going to allow maybe unapproved medical products or second uses of a drug to be used in emergency situations. So it kind of probably moves it more quickly through what would be the normal drug approval process, or at least authorization for another usage. So we're watching that headline, and that's been one of our big stories, Stephen. So I do wonder, from the Fed's perspective, and Jay Powell, what should he be focusing on right now when it comes to policy? Is it kind of what's going on with the virus? Is it what's going on in the economy, or is it a little bit of both?
I think it's a little bit of both. Not that he is as concerned as to what's going on in the market as a result of the therapeutic that you mentioned and the announcement, I think, yesterday that we may have a vaccine yet this year. Those have given the Fed some breathing room because the market is not paying attention so much to what they're doing or so much to what the economy is doing. It's driven by anything that can reduce the uncertainty as to where the virus is going and as a result where the containment policies are following. And so anything that helps the markets believe that there's an opportunity for reopening sooner rather than later, which will depend on therapeutics, testing, vaccine, that just gives the Fed an opportunity to pay attention to what they're really most concerned about, and that is the economic impact and what that economic impact is having on businesses, and is that creating a bind in credit markets? Right. Because at the end of the day, the Fed has announced, and rightly so, that it's most concerned to make sure that credit markets or friction in credit markets do not exacerbate the recession, which, as we all recall from 2008, turned out to be the case, where as much as the Fed did, it was following up after credit markets started to exacerbate the recession, and so it's worked very hard to be in front of it, and that, I think, is where their principal focus is, and rightly ought to be.
And so, Dr. Skanke, only about a minute left here as we prep for Jay Powell. What's your 1 minute assessment of the entire response? Because you've worked in many aspects of the government. You obviously know this part of the policy incredibly well, but synthesize for us so far the fiscal, the monetary, and the overall response from the government here.
It's easy to be critical of the government, particularly Congress and the White House, for being late to addressing some of these serious issues, and that's something that we can talk about another time. But what's been amazing was when they started to focus their attention on it, how quickly they were able to put together these acts. And when you look at the CARES Act and $2.2 trillion, well focused in areas that needed the particular attention to do just what it's supposed to do, and that is to preserve the employer-employee relationship, consumer purchasing power, so that when it's time, when it's possible and safe to reopen the economy, that consumer spending will be there and ready to go.
Yeah.
Fed, seeing that there was a delay in the fiscal side of things responding, went at it full bore, even in areas that probably it could only have a small positive impact.
Got it.
But
Stephen,
nevertheless,
we've got to jump in just because we're getting ready for Jay Powell. But thank you, as always. Stephen Skanke, Chief economic advisor over at Keel Point. And of course, we do know we got that Fed decision, leaving rates as expected, continuing purchases. Markets are pretty much where they were prior to that release. The big thing is the Fed declined to adjust its forward guidance. That's a key takeaway, Jason.
Acting like every CEO in America and probably across the world, right? Basically saying, we don't know what's coming next. And I think that's where a lot of the questions are going to be for Jay Powell for sure. Really sort of going to the heart of what is he looking at? What is going to make them change their mind? Let's go to Jay Powell right now.
I would like to begin by acknowledging the tragic loss and tremendous hardship that people are experiencing, both here in the United States and around the world. The coronavirus outbreak is first and foremost a public health crisis, and the most important response is coming from those in the front lines, in hospitals, emergency services, and care facilities. On behalf of the Federal Reserve, let me express our sincere gratitude to those dedicated individuals who put themselves at risk day after day in service to others and to our nation. The forceful measures that we as a country are taking to control the spread of the virus have brought much of the economy to an abrupt halt. Many businesses have closed, people have been asked to stay home, and basic social interactions are greatly curtailed. People are putting their lives and livelihoods on hold at significant economic and personal cost. All of us are affected, but the burdens are falling most heavily on those least able to carry them. It is worth remembering that the measures we are taking to contain the virus represent an investment in our individual and collective health. As a society, we should do everything we can to provide relief to those who are suffering for the public good. While many standard economic statistics have yet to catch up with the reality we're experiencing, it's clear that the effects of on the economy are severe. Millions of workers are losing their jobs. Next week's jobs report is expected to show that the unemployment rate, which was at 50-year lows just 2 months ago, has surged into double digits. Household spending has plummeted as people stay home, and measures of consumer sentiment have fallen precipitously. Hotels, airlines, restaurants, department stores, and other retailers have been particularly hard hit. Manufacturing output fell sharply in March and is likely to drop even more rapidly this month, as many factories have temporarily closed. Overall, economic activity will likely drop at an unprecedented rate in the second quarter. Inflation is also being held down, reflecting weaker demand as well as significantly lower energy prices. Both the depth and the duration of the economic downturn are extraordinarily uncertain and will depend in large part on how quickly the virus is brought under control. The severity of the downturn will also depend on the policy actions taken at all levels of government to cushion the blow and to support the recovery when the public health crisis passes. The Federal Reserve's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We're also committed to using our full range of tools to support the economy in this challenging time. Last month, we quickly lowered our policy interest rate to near zero. We stated then and again today that we expect to maintain interest rates at this level until we're confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. Of course, lowering interest rates cannot stop the sharp drop in economic activity caused by closures and other forms of social distancing. And low rates will not effectively spur the economy if those rates do not feed through to broader financial conditions or if households and businesses are unable to get credit. The economic disruptions caused by the virus created tremendous strains in some essential financial markets and have impaired the flow of credit in the economy. Without access to credit, families can be forced to cut back on necessities and could lose their homes. Businesses can be forced to downsize or close, resulting in further losses of jobs and incomes and worsening the downturn. Preserving the flow of credit is thus essential for mitigating the damage to the economy and setting the stage for the recovery. We have been taking broad and forceful actions to these ends. To support the flow of credit to households and businesses, foster smooth market functioning, and promote effective transmission of monetary policy to broader financial conditions, we have been purchasing large amounts of Treasury and agency mortgage-backed securities. The markets for these securities play a critical role in the economy, and they came under great stress last month as the scale of economic disruption became clearer and as investors clamored for liquidity. Our purchases have helped market conditions improve substantially in recent weeks. In light of this improvement, we have slowed our pace of purchases. We will continue our purchases of Treasury and agency mortgage-backed securities as needed. While the primary purpose of these securities purchases is to preserve smooth market functioning and effective policy transmission, the purchases will also foster more accommodative financial conditions. We are also undertaking programs to provide stability to the financial system and to more directly support the flow of credit in the economy, for households, for businesses of all sizes, and for state and local governments. These programs benefit the economy by providing financing where it is not otherwise available. In addition, by serving as a backstop to key credit markets, the programs can improve market functioning by increasing the willingness of private lenders to extend credit. Many of these programs rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing and support from Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. I would stress that these are lending powers and not spending powers. The Fed cannot grant money to particular beneficiaries. We can only make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers will benefit from our programs, as will the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend, and to make decisions about where we as a society should direct our collective resources. The CARES Act and other legislation provide direct help to people, businesses, and communities. This direct support can make a critical difference, not just in helping families and businesses in a time of need, but also in limiting long-lasting damage to our economy. At the Fed, we're doing all we can to help American families and businesses weather this difficult period. When the spread of the virus is under control, businesses will reopen and people will come back to work. We will continue to use our tools to assure that the recovery, when it comes, will be as robust as possible. Thank you, and I'll be glad to take your questions.
Tina Smialek.
Hi, Chair Powell. Thanks for taking our questions. You guys have cut rates to zero. You're buying up huge quantities of government debt. I guess the question is, what more can you realistically do to help the economy? And where do you see a need for Congress to step in?
So let me say that we're committed to using our full range of tools to support the economy in this challenging time. We're going to use them, as I mentioned, forcefully, proactively, and aggressively until we're confident that we're solidly on the road to recovery. And also to assure that recovery, when it comes, will be as robust as possible. As long as needed, we'll use them. And I would just say we have a number of dimensions on which we can still provide support to the economy. As you know, our credit policies are not subject to a specific dollar limit. They can be expanded as appropriate, and we can do new ones. So we can continue to be part of the answer. Will there be a need to do more, though? I think the answer to that will be yes. I would say Congress has also reacted quite aggressively and strongly with the CARES Act and other laws, several other laws, and that's appropriate. With enhanced unemployment insurance and the Paycheck Protection Program, we've seen an extraordinary, historically large reaction. But I would say that it may well be the case that the economy will need more support from all of us if the recovery is to be a robust one.
Nick Timrose.
Thanks, Chair Powell. Nick Timrose of the Wall Street Journal. I want to follow up on Gina's question and ask what specifically do you think elected officials should consider in order to help return or hasten a stronger return to full employment? And what policy tools did you discuss at your meeting today that might be used to stop a deflationary spiral?
So let me start. I'll take the questions in the order you gave them. So, in terms of, if I can say, legislative priorities, we're not responsible for fiscal policy. Those will be decisions for Congress to make. But I would say that policies that protect workers, businesses, and households from avoidable insolvency, that keep businesses going, so that they're able to produce goods and to either hold on to their employees or quickly rehire them. Those are going to be key policies. They'll come with a hefty price tag, but we would come out of this event eventually with a stronger economy and with less long-run damage to the economy. So that's a key thing that really Congress could do over time. In terms of what we can do, I mentioned we have our credit facilities are wide open. We can do more on that front. In addition, we've had extensive discussions, as I've mentioned, done a lot of thinking about what monetary policy might look like in coming months over a range of potential scenarios for the economy. We do think that our policy stance today is right where it should be for now. As you know, we cut rates to the effective lower bound. We've said that we'll keep them there until we're confident that the economy has weathered the effects of the outbreak and is on track to achieve our goals. With asset purchases, we're continuing to purchase Treasury securities and agency MBS in the amounts needed to support smooth market functioning. So we're doing those things, and I would say that we'll continue to use our tools as needs be.
Steve Leisman.
Mr. Chairman, question, Steve Leisman with CNBC. I've got two questions here. First of all, why aren't you announcing or conducting a specific quantitative easing program? And maybe you could explain what the context is now of the purchases that will be made and the amounts that are to come. The second question I have is the Federal Reserve really taking enough risk to help households and businesses here, in that you just said that the programs that are out there may be best for those who are able to repay loans, but so don't you have a series of programs essentially lending only those able to repay, which is essentially helping those who may need it the least? Thank you.
So let me say again, in terms of asset purchases and other measures, we do think our policy stance is appropriate now. We've had discussions, as I've mentioned, over time and done quite a bit of thinking about what we might do in the future. We think for now our policy stance is appropriate. We're not going to change it now. And we're really waiting to see more from the economy. There are a range of potential paths the economy could be on. And I think as the time approaches then we'll address your first question, which is about asset purchases. But that's not something we're doing today. It's something that we have talked about, and for now we like our current policy stance. In terms of risk, we operate under the laws that Congress passes, and there are a number of aspects under Section 13.3, and you can see that they've permitted us to, I think, move very quickly and move into areas where we've never been before and do so quite aggressively. So I think we're going places and providing help in places where we never have, and I'm glad that we are. I think it's appropriate that we are. Nonetheless, these are lending powers, and if you read Section 13.3 of the Dodd-Frank Act, or the Federal Reserve Act, I know you have, it does require that we be secured to our satisfaction, and we can't lend to insolvent companies. It's clear these are lending powers, and we are ultimately bound to implement the laws that Congress gives us. We do not make grants. We can't make grants. And the reason I raised that in my remarks is that I just want to be clear on that. We can do what we can do, and we will do it to the absolute limit of those powers. We'll keep at it, and I just want people to know that we will be at it with the legal authorities that we have until we get through this thing. We will keep using our authorities. But there are authorities that we don't have, and there may be a need for those authorities to be used as well as ours.
Heather Long.
Hi, Chair Powell. It's Heather Long from the Washington Post. I have two questions for you, both on timing. The first, do you plan to launch the corporate credit facility and the Main Street lending facilities in May or early May? Anything you can give us a sense on timing? And the second, in the statement you refer today, the FOMC refers today to a lot of medium-term risks from the pandemic. That sounds like you all think this is going to be a long recovery, a long road to recovery. Can you give any more guidance on how you all see this recovery taking shape? Thanks.
Sure. So in terms of those facilities, the corporate credit facilities are near being finalized and will be operating, I would say, soon, fairly soon. Main Street facility is... We're close to announcing, to issuing a new term sheet. As you know, we put out a term sheet for comment a while back, and we got a couple thousand comments. We've carefully studied them. We've tried to reflect those in what we're doing now. I think with Main Street, there'll be at least a couple of different kinds of lending going on there. This is a broad area of the economy with many different kinds of credit needs, so we're going to keep at that for some time, I think, adding in sectors and lending products. So I think we'll probably be continuing to work and expand Main Street for some time, but it won't be done quite as quickly. But the first part of it, I think, will be done fairly quickly. In terms of our statement, so what we said was that I'll just read the sentence. It says, ongoing public health crisis will weigh heavily on economic activity, employment, and inflation in the near term and poses considerable risks to the economic outlook over the medium term. So what we meant by that over the medium term. So obviously, what we're talking about is not right now in the very near term. It's between now and the long term. So the next year or so. And I would point to a couple of risks to the outlook that what we were thinking of. First is just the virus. How long will it take to get it under control? Will there be additional outbreaks? Will there be drugs that can either treat it or a vaccine of some kind? So all of that is very much shrouded in uncertainty. The second issue, and this is a very substantial one, is just the possibility of damage to the productive capacity of the economy through a couple of channels. The first is just workers who, if one is unemployed for an extended period, that person can lose the skills that are needed, can lose touch with the labor force, and have difficulty restarting his or her career. So that's a feature of deep and long recessions, and that's something we've got to watch out for. Another is just businesses. These thousands of great medium and small-sized businesses that we have all over the country, they're worth so much more to the economy than the sum of their net assets. They contain, they're job creators. They're really important. And if we see an unnecessary insolvencies, a wave of those, that could be damaging to the performance of the economy over time. So the good news is that we have policies, as I mentioned in my remarks, we have policies that can address those things, but not perfectly. So that's another risk. The third thing I would point to is just the global dimension. This is a very global phenomenon, and we're seeing economic data from around the globe, which is very, very negative, and that too can weigh on U.S. economic performance over time. I would say just on the U.S. economy, there are things you can say. One can say. The first is that in the near term, we're going to see, significant declines in economic activity, significant declines in employment, and increases in unemployment. We're going to see that as a consequence of the virus and the measures we're taking to protect ourselves from it. The next phases are more uncertain, highly uncertain, but we will go through a phase starting fairly soon where we begin to reopen the economy, and probably the economic activity will pick up as consumer spending picks up. Consumer spending, as I mentioned, has gone down quite a lot. It'll begin to pick up as people start to return to their normal patterns of spending. But the chances are that it won't go right back to where we were, because people will, until they're confident that the virus is well and truly under control, then they will be somewhat probably reluctant to to undertake certain kinds of activity. So it may take some time for us to get back. It probably will take some time for us to get back to, to a more normal level of unemployment and ultimately to maximum employment.
Okay, James Politi.
Thanks, Chair Powell. You didn't firm up your guidance on, this is James Politi from the Financial Times. You didn't firm up your guidance on interest rates at this meeting. And given the risks that you just outlined, under what circumstances would you strengthen the Fed's commitment to keep rates at the lower bound? And is there any danger to delaying that pledge? And on the credit facilities, what kind of demand are you expecting for the programs that were set up under the CARES Act? And are you expecting them to rapidly reach capacity like the PPP plan did?
Okay, so on the first, as I mentioned, we moved very quickly, very aggressively. We were the first to return to the effective lower bound where we are now. We got there essentially right away, and we think that's the right place to be. We think if you look at surveys, you look at market pricing, the market expects us to be there for a good while, and that's appropriate. So, it's not as though the market is pricing in a near-term liftoff or anything like that. And let me just say, we're not be in any hurry to withdraw these measures or to lift off. We're going to wait until we're quite confident that the economy is well on the road to recovery. So we see our current stance and our current guidance, and I would say the same thing about asset purchases. We see them as appropriate. I've also mentioned now a couple times that we have done a lot of thinking about what monetary policy might look like over coming months, and that would depend on where we are in a range of potential economic scenarios. So we were thinking about that all the time, but right now, for now, we think our current stance is appropriate, so we made no change in it today. Second question was so the thing about our facilities is Treasury still has plenty of equity. So we've said that if demand for our facilities is greater than we've estimated, then we'll expand them. And we have the ability to do that. So it won't be the way the Paycheck Protection Program is, where there's a specific amount appropriated for it, and then there's no more money. That will be unlikely to happen here unless we exhaust Treasury's equity, and we're a long way from doing that. The second thing I would say is, and you've all seen this, is when we announce these facilities, and I mentioned this in my remarks, it's not just the actual lending we do, we build confidence in the market, and private market participants come in, and many companies that would have had to come to the Fed have now been able to finance themselves privately since we announced the initial term sheet on these facilities. So that's a good thing. Companies are out there financing, they're out there raising liquidity. We haven't made any corporate loans in those facilities. We've made the short-term money market loans, but we haven't made any of them. And yet there's a tremendous amount of financing going on, and that's a good thing. So for that reason, the ultimate demand for the facilities is quite difficult to predict, because there is this announcement effect that really gets the market functioning again. Of course, we have to follow through, though, we will follow through to validate that announcement effect.
Okay, Howard Schneider.
Oh, hi, Chair Powell, and thanks for doing this. I wanted to get you a little more expansion on the timing of recovery and the connection between the health response. You said earlier, I think, that you thought the second half of the year could see a pretty robust rebound. Is that now out of the question? And do you think a steady recovery is really possible until a vaccine's developed, given the patchwork of measures we see taken around the states? Is that going to really lead us to a steady path out, absent a vaccine?
As you know, economic forecasts are always uncertain. Today, they're unusually uncertain, and that's really because so much of the performance of the economy depends on the path of the virus and the success of the measures we take to control it, our success in reopening the economy, and also the time it takes to develop new drugs. And our tools, the things that we do, don't affect any of those things. We're not experts on those things either, but what the experts tell us is that the outcomes are highly uncertain. So this is an unusually new kind of uncertainty added on top of our regular uncertainty. But I will say I think there are a few things you can say about the path ahead. First, this time now is going to be a time of sharp contraction in economic activity, high unemployment. Personal consumption expenditures have declined sharply, business investment as well, unemployment moved up. We're going to see economic data for the second quarter that's worse than any data we've seen for the economy. And they're a direct consequence of the disease and the measures that we're taking to protect ourselves from it. So then we'll enter this new phase, and we're just beginning to maybe do that, where we will formal measures that require social distancing will be rolled back gradually and at different paces in different parts of the country. And in time, during this period, the economy will begin to recover. People will come out of their homes, start to spend again. We'll see unemployment go down. We'll see economic activity pick up. And, when will that be? It's very hard to say. But let's just say for this purpose that it's in the third quarter. So, as I mentioned earlier, that could be a fairly, a large increase. Given the size of the fall, the increase could also be substantially large, although it's unlikely that it would bring us quickly all the way back to pre-crisis levels. Of course, this is the period as well that carries the risk of new outbreaks of the virus, something we really want to avoid. I think then, after that period, at some point you will have, the kind of formal social distancing measures will be gone, but you'll still be left with probably a level of caution on the part of people who will worry and probably keep worrying for some time. You would think that behavior will change as people gain confidence. So the sooner we get the virus under control, the sooner people can regain that confidence and regain their economic activity. I think trying to be really precise about when that might happen and what the numbers might look like is, I think it's very tough to do that.
Okay, Steve Matthews.
Steve Matthews with Bloomberg. Chairman Powell, you've noted a number of times over the last year that there's been a broadening out of job gains with marginalized workers, people who've been left out of the recovery over the 10-year period, finally making job gains, and particularly minorities, but also many other workers. Do you worry that this recession is going to fall hardest on those workers who struggled and just got job gains in the last year or two, and that it may take years from now before there are opportunities for them again?
Yes, that's exactly what I worry about. So unemployment has tended to go up much faster for minorities and for others who tend to be at the low end of the income spectrum, and it tends to come down faster as well, but it tends to go up faster and be much, much higher. And we were in a place only 2 months ago. We were well into beginning the second half of the 11th year is where we were. And every reason to think that it was ongoing. We were hearing from minority, low and moderate income and minority communities that this was the best labor market they'd seen in their lifetime. All the data supported that as well. And it is heartbreaking, frankly, to see that all threatened now. All the more need for our urgent response, and also that of Congress, which has been urgent and large, and to do what we can to avoid longer run damage to the economy, which is what I mentioned earlier. This is an exogenous event that it happened to us. It wasn't because there was something wrong with the economy, and I think it is important that we do everything we can to avoid that longer run damage and try to get back to where we were, because I do very much have that concern. I think everyone is suffering here, but I think those who are least able to bear it are the ones who are losing their jobs and losing their incomes and have little cushion to to protect them in times like that. So yes, that's a very big concern.
Victoria.
Hi, I'm Victoria Guido with Politico. The Paycheck Protection Program has experienced some logistical problems because of the speed at which all of this is happening. For the Main Street lending facility, which will also work through banks, what lessons are you taking away from that? And then more broadly, you mentioned earlier this year that the federal debt was on an unsustainable path. And I was just wondering, for Republicans that are starting to get worried about how much fiscal spending they're having to do in this crisis, whether that should be a concern for them.
So a couple things. This is different from the PPP, the Paycheck Protection Program, in two ways. One is these are not grants; these are loans. So I don't know that the demand will be quite as strong as it has been for the PPP. I don't know that, but and the second thing is we won't run out of money. It's not a limited pot, so there won't be this incentive to try to get there first and that sort of thing. So I'm hopeful we will very much try to learn as much as possible from that facility and from all the other ones too. We have a lot to learn here, so we'll certainly be trying to do that. In terms of fiscal concerns, so I for many years I've been before the Fed. I have long time been an advocate for the need for the United States to return to a sustainable path from a fiscal perspective at the federal level. We have not been on such a path for some time, which just means that the debt is growing faster than the economy. This is not the time to act on those concerns. This is the time to use the great fiscal power of the United States to do what we can to support the economy and try to get through this with as little damage to the longer run productive capacity of the economy as possible. The time will come again, and reasonably soon, I think, where we can think about a long-term way to get our fiscal house in order, and we absolutely need to do that. But this is not the time to be, in my personal view, this is not the time to let that concern, which is a very serious concern, but to let that get in the way of us winning this battle, really.
Okay, Edward Lawrence.
Oh, yeah. Thank you, Mr. Chairman. Edward Lawrence from Fox Business Network. Now, given the amount of stimulus on the fiscal side and monetary policy side, how much weight do you give to finding a vaccine from clearing that uncertainty you talked about around treatment and whatnot, for the Federal Reserve pulling back on some of the Fed's actions and raising the rates from the zero lower bound? Also, when does that Main Street lending facility get deployed? Because you talked about soon, some businesses are in need now. Thank you.
So we don't, we're not in a position to make, a reliable assessment of when a vaccine or a therapeutic drug would be ready. And so we're not going to set our policies based on our estimate of that. We're going to just provide the support that we can with the tools that we have, and we're going to keep doing that until the recovery is well underway. In terms of Main Street, so you know the story. We put out a term sheet. We got a lot of comments. We took those very much to heart. We spent a great deal of time here. It's a challenging space because it's many different kinds of borrowers. They have different needs, different sizes of companies, and so we're as I mentioned, we're very close to announcing a new term sheet, which will then become operative fairly quickly. My guess is, though, that we'll keep looking to add products and add different kinds of borrowers to that as we go. And we're well aware of the importance of doing it as quickly as possible. We're very much in touch with the urgency of that need.
Okay, Don Lee.
Chair Powell, it's Don Lee from the LA Times. Just wanted to follow up on the question on the labor market. I know you said that it's highly uncertain, but there are analysts who think that we'll have very high unemployment until even the end of next year, as high as 9%. And at this point, can you just talk a little bit more about what you see as the path of employment in the coming months and into next year?
Sure. So unemployment's going to go up to a high number in the second quarter. Uncertain what the number will be. And that's because so much economic activity has been shuttered, really, as we take social distancing measures. So sometime fairly soon here, and probably gradually and at different paces at different parts of the country, we'll see the social distancing measures rolled back. People will begin to spend more money. It's really consumer spending has fallen precipitously. And once that starts to happen, people will get hired back and unemployment will go back down. I don't think it'll get anywhere near the historically low levels that we had in as recently as February, 3.5%. I think it will take some time for that to happen, for us to get back to anything that resembles maximum employment. But I mean, the main thing we want to get back on that road. We want to get that recovery going and get people back to work as fast as we can. Not faster than we can, but as fast as we can. And the main thing is to get into that stage where the economy's healing, where we have the disease under control, where we don't take too much risk of second and third waves and that sort of thing, and get people back to work. And it's again the path of it is highly uncertain, but we will be there with our tools, supporting the economy and supporting that recovery.
Scott Horsley.
Thanks, Mr. Chairman. After the financial crisis, banks were instructed to up their capital so they could weather an economic shock. What kind of steps do you think we need to take for the economy writ large to make it more resilient to this kind of shock?
Can you just say that part? You're a little bit low volume.
Yes. What kind of steps could we take to help the economy as a whole be more resilient to this kind of exogenous shock?
It's an extraordinary shock, unlike anything certainly that's happened in my lifetime. And a couple things come to mind. I think the time will come for a careful assessment of the answers to those questions. It's early to be asking them. We're still putting out the fire. We're still trying to win, and I think we'll be at that for a while. But I'd point to a couple of directions. We worked hard to strengthen the banks, much higher levels of capital, liquidity, a far greater sense of what the risks are they're running and how to manage them. So the breakdowns that we've seen in market function have really been in the capital markets, and I wouldn't rush in with prudential regulation into the capital markets, but I think, and we did plenty of things, tri-party, we did a lot of reform in the capital markets, money market reform, tri-party repo reform, central clearing, all these important things. But there will no doubt be, with this, the size and force of this shock will no doubt reveal weaknesses in the financial architecture, and we'll have to go to work on those. I also think it tells you the importance of getting your fiscal house in order. The U.S. really hadn't gotten back to where we needed to get on fiscal policy, and so we have an already high level of debt to GDP and rising quickly when this shock arrived. Now we have the fiscal capacity to deal with it, I believe. But we will need to, ideally you would go into an unexpected shock like this with a much stronger fiscal posture.
Mike McKee.
Mr. Chairman, given the demand shock and the drop in oil prices, do you anticipate that we might see any kind of deflation, even for a very short period, that would require a Fed response? If we get a negative print on CPI or PCE, how should people think about that? And second question, there is a disconnect, it appears, between the markets and the economic outlook right now. And I know you said that this isn't the time to worry about moral hazard, but do do you worry with the size of stimulus that you and the Congress are putting into the economy, there could be financial stability problems as this goes along?
In terms of inflation, we think that inflation is very closely and strongly related to inflation expectations. And during the global financial crisis, there was a concern that we might see deflation, but it didn't happen. Inflation tended to move down a little bit, as it will when demand is weak. But inflation expectations did not move strongly down here in the United States. They have in other places in the world, though, over the past 25 years. There's been downward pressure on inflation really for several decades now. So I would say as long as inflation expectations remain anchored, then we shouldn't see deflation. And the Federal Reserve is strongly committed to maintaining 2% inflation over time. So we'll be there to work on that. I think you asked really about headline inflation. If low energy prices, very low energy prices, were to drop headline inflation negative, I would hope that people would see through that, and we'll be monitoring it very carefully. Would see through it though, and look to core, which is a better predictor of future inflation. So, needless to say, we'll be keeping very close track of that. In terms of the markets, our concern is that they be working. We're not focused on the level of asset prices in particular. It's just markets are trying to price in something that is so uncertain as to be unknowable, which is the path of this virus globally and its effect on the economy. And that's very, very hard to do. That's why you see volatility the way it's been, market reacting to things with a lot of volatility. But, what we're trying to assure really is that the market is working. The market is assessing risks. Lenders are lending, borrowers are borrowing, asset prices are moving in response to events. That is really important for everybody, including the most vulnerable among us. Because if markets stop working and credit stops flowing, then that's when you see very sharp negative, even more negative economic outcomes. So, and I think our measures have supported market function pretty well. We're going to stay very carefully monitoring that. But I think it's been good to see markets working again. Particularly the flow of credit in the economy has been a positive thing as businesses have been able to build up their liquidity buffers and households have been able to be home. People have been home, concerned about their jobs, but they're not concerned about the financial system collapsing as they were in 2008 and 9.
Okay, Chris from the AP.
Hi, Chair Powell. Chris Regaber, last recession, and then eventually, of course, the unemployment rate did go lower than people thought. Second question is just on the money from Treasury, the $454 billion. It sounds like you want to keep that in reserve for programs that have high demand, such as the Main Street program. Are you willing to use that to backstop, say, a program that is having more losses? What's your tolerance for loss among that $454 billion? Thank you.
So in terms of the labor market, the risk of damage to people's skills and their careers and their lives is a function of time to some extent. So the longer one is unemployed, the harder it gets, I think, and we've probably all seen this in our lives, harder it is to get back into the workforce and get back to where you were, if you ever do get back to where you were. So, and longer and deeper downturns have left more of a mark generally in that dimension with the labor force. And so that's why, as I mentioned, that's why the urgency in doing what we can to prevent that longer run damage. It doesn't have to be that way. We won't be able to limit all of it, but we do have the tools to do what we can to keep people in touch with the labor force and working, and also out of insolvency too. It doesn't seem fair that people should lose everything they have, including their homes, over this. So, nonetheless, there will be some of that, but we do have some tools to ameliorate that. In terms of the money, the $454 billion. It's a couple things. First, the Treasury Secretary really has authority over that, right? And it stands in front of our losses. But I do think we're clearly moving into areas where there is more risk than there has been in the past, and that's okay. I think that's what we're supposed to do. This is a very unusual time, and so. But in terms of the way to think about that money, I think that's really a question for the Treasury Department. We set up the facilities and we work very, very closely and successfully and collaboratively with the Treasury on this, but that particular aspect of it falls more to the Secretary.
Okay, we'll go to Nancy Marshall-Genzer for the last question.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I'm wondering what you would say to savers who are hurt by very low interest rates and maybe going into investments, maybe in the stock market, that aren't so great for them. And also, I'm wondering if you can give us any more of a clue as to how long you think we're going to have interest rates near zero.
So we think that low interest rates affect the economy through a number of channels in a positive way. Lower interest rates support economic activity through channels that we channels that we understand reasonably well. They make it cheaper to borrow. They make they drive your costs of borrowing down. They do raise asset prices, including the value of your home. If your saver owns a home or has a 401k, your saver will benefit from that. But for people who are really just relying on their bank savings account earnings, this is that's you're not going to benefit from low interest rates. But we have to look out for the overall economy. Low interest rates support employment; they support economic activity, and those are our mandates. And I think for the overall good of the economy, low interest rates are a good thing. And it's not to say they're good for every single person, but that shouldn't stop us from doing what we think is good for the whole. In terms of how low, I really don't want to speculate. We will turn to questions like that soon enough. But in terms of how long we'll stay and under what conditions we'll stay at the effective lower bound, those are just exactly the things we're thinking about right now. We like the place we are. We've said that we'll keep our rates where they are until we're confident that the economy has weathered the effects of the outbreak and is on track to achieve our goals. So that's where we are. We're not changing that guidance today. But it'll be. That means we're going to be very patient. That means we're not going to be in any hurry to move rates up.
Thank you very much.
Thanks.
All right, so you've been listening to Fed Chair Jay Powell on this interest rate decision day by the Fed. Largely what we got, Jason, from the Federal Reserve, of course, as expected. I think some of the key headlines, they're going to keep the zero rate pledge in the virus era. Central bank saying it sees medium-term pandemic risks. Says corporate credit facilities will be up soon. And he says now isn't the time to be worried about federal debt. And talking about increasingly because of those stimulus programs that are being put out there to help companies and individuals. So he says, don't worry about that. So, at this point. So a lot there. I think a lot to be expected.
Yeah, and we'll unpack it with our experts coming up in just a few minutes. We should note, and we'll hear some more figures from Charlie Pellet in just a minute. Stocks near their highs, and that has not always been the case, to be fair to Chair Powell in the market when he has taken the podium. But throughout, you saw stocks tick up higher there. He has been a voice of calm, a voice of confidence in all of this, and certainly delivered on that today, at least in my viewing and listening.
Right, and the markets have been rallying today, so to hold on to it, you're correct. After the Fed chair makes some statements, I thought it was interesting. In our Luke Howa, we've got a live blog going about what the Fed had to say, and what Jay Powell specifically, and the chairman saying it doesn't seem fair that people should lose everything that they have, including their homes, because of this. But he said that will happen, and we can ameliorate some of that, and that is as a result of Fed policy. And as he stressed, we need some more policy from lawmakers and from the federal government.
And one of the most potent quotes, and really a poignant quote that he said, was right at the beginning. He said, the burdens are falling most heavily on those who are least able to carry them. And that's a very powerful statement from the Fed chair, who is looking at this economy, its fragility, and candidly, the unevenness in which this virus is really hitting those most vulnerable. All right, you are listening to Bloomberg. Much more ahead, including our experts weighing in, as well as an update on the medical side of the virus. This is Bloomberg.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 40 minutes to go ahead of the closing bell. Fed Chair Jay Powell speaks. Stocks right now holding close to highs of the day, with the S&P up 86 points, a gain now of 3%. The Dow up 606 points, up 2.5%. And the NASDAQ Composite Index is up 332 points, up 3.9%. Should point out that the NASDAQ Composite Index now very close to break even for 2020. It is down by less than 0.4%. 10-year, the yield there 0.61%. Fed Chair Jay Powell saying the coronavirus has brought the economy to, quote, an abrupt halt, and it's uncertain how long the slowdown will last.
Both the depth and the duration of the economic downturn are extraordinarily uncertain and will depend in large part on how quickly the virus is brought under control. The severity of the downturn will also depend on the policy actions taken at all levels of government to cushion the blow and to support the recovery when the public health crisis passes.
Officials held interest rates near zero and pledged to keep them there until the nation is back on track. Gold up 48 cents the ounce now at $17.08. West Texas Intermediate crude up 24 at $15.31 the barrel. Again, recapping, S&P up 87, a gain now of 3.1%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Master, Jason Kelly on this Fed Wednesday. So let's bring in our team to talk a little bit more about what we heard in that press conference and from the Fed chief. Alex Harris is with us, bond reporter at Bloomberg News, on the phone in Queens, and Josh Wright back with us, chief economist at Right Side Advisors, joining us on the phone as well. I do want to kick off with you, Josh. What jumps out for you in terms of what we heard from Jay Powell?
Well, one thing is just the strength of the communication policy. I mean, we've talked before about some of the stumbles that Chair Powell has had over the years, but he just sounded so confident. You could tell that this was someone who is used to being a decision maker, and he's not just a pointy-headed technocrat. Although, you know, as a former technocrat myself, I've got a lot of sympathy for that.
No, but you know what? We're in an era where we're looking for leadership, right? And people to say things that provide some calm. And we've gotten a lot of that from Jay Powell. I think many would agree about that.
He sounded steady. He sounded clear on what we know and what we don't know. And here's how we're going to think about it as we start to learn more.
Yeah, it's interesting. I mean, even just the visuals, because Carol and I were both watching it, you know, from our homes, and all the reporters, you know, working from home, or in some cases working from the office, like all dressed up. And there, you know, darn it, is Chair Powell, like at his podium. He's got his mics, he's got his suit. Like the whole vision, you know, really does, as you say, Josh, sort of exude this air of confidence. All right, Alex Harris, come on in here. I mean, this is a Fed that has been incredibly active, to say the least, over the past 6 to 8 weeks. What do you make of where the Fed sits now, and what did you hear from Chair Powell about where it goes from here?
Jason, I was disappointed. And Josh could understand this, you know, being a bit of a wonk and the technocrat side. You know, at least for the front end, you know, one of the things everyone was sort of waiting on is the Fed funds rate is really close to the bottom of that target range, and the Fed likes to move it back to the middle, and we got nothing on it, which was unusual, because this is usually a time where they're like, we like to get ahead of this. So I would have liked to have heard maybe what was their decision on it, because they've usually been so quick to jump on that before, and maybe the minutes will give us something. But I guess, you know, more broadly, you know, I think it's going to be interesting in his comments, you know, when he talks about the breakdown in the capital markets. You know, and I've said this before, I honestly think that, you know, central banks and the regulators are going to have to do some soul searching here in terms as to why things broke so bad, and looking at, you know, holistically at regulation. And that's a side effect of everything that they're doing. You know, but QE is about, or the asset purchases really isn't about, hitting rates, and bringing down the back end of the Treasury curve. That's about making sure that the Treasury market, what's supposed to be the most liquid market in the world, is actually functioning. And so you really, for the Fed, part of this, aside from watching the data and seeing how things evolve, is taking a look at the markets and really understanding their role, because the balance sheet is growing massively, and that's going to continue, and they're going to carry that. And I think, we need to stop and think about asset prices. I mean, there's a reason why stocks are continuing to rally, because we've seen this show before. We saw it a decade ago.
Well, this is a good point, but Josh, what's your response to what Alex is saying?
I think there are some serious questions about how the financial markets may be changed by the Fed in response to some of these facilities. I mean, I noticed getting a little wonky here, as Alex said. If you look at the Main Street lending program, they're planning to use the secured overnight funding rate, SOFR, their preferred replacement for LIBOR. And I've been hearing that there are banks that are uncomfortable with that. So the way they structure these facilities, a lot of these details, they could have long-lasting impacts. And we already saw that a lot changed after the last financial crisis, with the Fed getting so involved in mortgage markets. The whole market started to shift around that, and that's part of why we saw the mortgage REITs, who've had an important role in some of the market disruptions we saw in March. These other institutions that were doing the intermediation of getting the funds out to households in this new environment, and then they ended up becoming a problem years down the road after the Fed's intervention years ago. So what are going to be the new institutions and practices that are going to come out of this round of interventions that will lay the seeds for the next crisis?
Well, it's a really interesting point, Josh, and it brings up one of the obvious sort of questions and threads that we've all been pulling, which is, what did we learn from the last crisis that is informing the way we act now? And I do wonder that in the case of the Fed, especially in light of a lot of people looking to the Fed for leadership. I mean, you think about what they're doing for smaller states or smaller municipalities and governments, in the absence of maybe some help from other parts of the federal government. I mean, what do you worry about in terms of what we need to learn from this crisis for the next one?
Well, if the lesson of the last crisis was that our financial institutions need a lot of resilience in the form of capital and liquidity, now what we're learning in this crisis is the importance of resilience in our non-financial corporations. What do their debt loads and their balance sheets look like? What do their supply chains look like? What are their contingency plans? And we are going to have to take a hard look at that when we rethink our whole economy in the coming months. One of the challenges, though, is that the Fed doesn't have a lot of authority there. The Fed is not going to spend a lot of time looking over the shoulders of small business owners beyond just determining whether or not they're eligible for a certain loan. And there's a certain influence to get from that, but how many of these smaller businesses are even going to take out the loans? Because they are designed to run on thin margins. That's just the nature of the business model.
It's interesting.
So that's one of the reasons we're concerned about consolidation and having the larger chains take over.
Neil Dutt of Renaissance Macro, who we talk to a lot here at Bloomberg as well, highlights what Powell said, now is the time to use the great fiscal power of the United States. I mean, I really do think it's not the first time Ben Bernanke or another Fed chairman, Janet Yellen, said, hey, we're doing all we can, but it's really up to you policymakers to do the rest of it.
Come on, Treasury, get on in here.
Right, and you have to be above and beyond because people are really being impacted desperately by this. Alex Harris, your thoughts here on this when you look at, what needs to be done on the fiscal side of things really to help out the overall system?
Oh, gosh, there's probably more heavy lifting that they can do here. Ben Bernanke used to say it, and I think he said it best, like, monetary policy is not a panacea. And I still think, yes, and I think Jay Powell was very diplomatic in the way he talked about, the things that Congress has done, but there's always more room here, and just tossing it to the Fed and expecting them to launch all these programs and then expecting them to have, sort of this overarching, just fix-it effect, and make everything okay. It's a lot to ask for them because, again, markets really got wrecked. And things seized up. And that's what they need to be focusing on is like, okay, why did all these markets that we made all these regulatory changes to seize, and what can we do about it? But again, there's only so much they can do. They can only keep rates low for so long before, again, it starts to have adverse effects. And I think really, if you take away one thing from, looking at
Alex, we got to leave it there. I'm so sorry. Alex Harris, bond reporter for Bloomberg. Josh Wright, chief economist at Right Side Advisors. This is Bloomberg.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 30 minutes to go ahead of the closing bell. Stocks now at a 7-week high on better than estimated revenue for Google's parent company and hopes for a coronavirus treatment. Oil surging. West Texas Intermediate crude up now by 24%, $15.27 a barrel. Gold up 0.1%, $17.09 the ounce. The 10-year down 2/30 seconds with a yield of 0.61%. Here's where we stand. S&P up 88, a gain of 3.1%. The Dow up 625, up 2.6%. NASDAQ surging 340 points, up by almost 4%, narrowing its loss for the year to less than 0.3%. Fed Chair Jay Powell says the coronavirus has brought the economy, quote, to an abrupt halt, and it's uncertain how long the slowdown will last, as officials held interest rates near zero and pledged to keep them there until the nation is back on track. He also had this to say about the labor economy.
While many standard economic statistics have yet to catch up with the reality we're experiencing, it's clear that the effects of on the economy are severe. Millions of workers are losing their jobs. Next week's jobs report is expected to show that the unemployment rate, which was at 50-year lows just 2 months ago, has surged into double digits.
Gilead Sciences says early results from a government-run study show its experimental drug to treat coronavirus help patients recover more quickly than standard care, suggesting it could become the first effective treatment for an illness that has turned modern life inside out. Gilead Sciences shares, they are moving higher today. Gilead up now by 6.9%. And airlines being subsidized to serve the most remote American airports can receive partial payments even if they cut flights during the new coronavirus epidemic under a plan announced today by the government. Among some of those airline stocks today, we are seeing UAL, that is the parent of United Airlines. Little change. We've got American up by 10%. UAL, is up by 10.7%. Southwest Airlines is up by 4.7%. Again, recapping, stocks higher, S&P up by 88 points, a gain of 3.1%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week. Jason Kelly, Carol Masser. We've spent a lot of time talking about the Fed, listening to Jay Powell. Obviously, the backdrop for all of this, Carol, is the virus. And ultimately, and you heard Chair Powell say this is a medical crisis, it's a health crisis, and so many of the questions and so many of the answers are hinging on when we get back to work. Well, when we get back to work is largely going to be dictated by both the therapeutics and the vaccines and all the treatments around this virus. Michelle Cortez has been following this as closely as anyone, one of the hardest working reporters at Bloomberg. So grateful to her for joining us, health science and medical technology reporter for Bloomberg, joining us on the phone from Denver. Michelle, so good to have you with us. I know it's an incredibly busy day, but when we were setting up this show, we knew we needed your input, we needed your expertise to help us understand some of the headlines that we've heard from Dr. Fauci and others, and from Gilead specifically about remdesivir. What do we need to know, and what does it ultimately mean?
So it has been one of the craziest days in my 25-year history of covering pharmaceutical drug development. Let me tell you that to begin with. What we know about the data is not an awful lot at this point, but Dr. Fauci was at the White House today, and he did tell reporters sitting with President Trump that these results do look significant and striking, and it looks like we might have a treatment for coronavirus is on the horizon. It could be coming as soon as this week because they've been working with the FDA. Basically, what they're saying at this point is that this will help you recover more quickly if you are infected, and they're hoping that it'll help people survive if they get it, but that one's not quite clear yet.
Okay, so it's not a vaccine. We're talking about people who are infected, so it would help those that are out there. How quickly would it ramp up and get used? We saw the headline about the government kind of moving to an emergency situation in terms of maybe giving this and making sure that patients have access to it. So give me an idea of time frame.
Exactly. Well, so Gilead also released another study today that showed that patients who only got this drug for 5 days did just about as well, and maybe in some cases a little bit better than those who got it for 10 days. So right there, that would double the number that we have. Also, it's important to remember that this is an infused drug, so it's not something that you can just take as a pill. It's not something that they can knock off in manufacturing plants easily. They actually have to create it. Gilead has said that they expect to have 1 million doses of it by December, but or 1 million courses of it by December. But that was a previous number, so it's unclear to us whether that's 1 million 10 days or 1 million 5 days.
So, Michelle, so this is something that, God forbid, we have a second wave, which we hear a lot of conversations about. That's largely what this would be useful for.
Exactly. Well, there certainly are still a lot of people who are getting infected now in the U.S. and around the world. And while we think and hope that the number of cases might decline over the summer, certainly it's not going to go away entirely. There is actually another set of information that I don't know if you guys are aware of. I don't know if anyone's aware of it. Bloomberg just broke this news on vaccinations. Have you guys heard about it?
I saw a brief, this was the Jen Jacobs story, I believe, around the vaccines, or maybe you were, I'm sure you were involved in it somehow too, but I saw her tweet. This is about vaccines potentially being available by the end of the year.
Exactly, yeah. It's called Operation Warp Speed that the Trump administration is just planning to announce soon. It's just early days yet, but Bloomberg did break this news, and what they're planning is they're planning to get all the vaccine manufacturers together, and the U.S. is going to basically underwrite it and take all the financial risk, and the goal is to have 300 million doses of the vaccine by January so that everyone in America can have one. If you want it, I guess. By January.
How much by January?
300 million.
300 million. Is that
amazing? Okay,
so wait, help me here. Michelle, you understand, as you said, this has been one of your craziest days of covering the pharmaceutical industry, and treatments. So how is that possible? Does it mean we don't go through the normal testing of a vaccine to make sure it's safe? Explain this to me.
I cannot even imagine how we would be able to go through the normal process of making sure a vaccine is safe. I don't even know of an example of a therapeutic or a vaccine that's been developed in less than 3 to 5 years. And that's really, really fast. It's a very slow and iterative process, especially for vaccines, because you need to give people a vaccine and then test them to see who gets it and who doesn't. And then you can know after you've done that process whether or not it works, right? And as we've already discussed, the number of cases are coming down. So how are you going to do that early trial to see if it works before you make 300 million doses? I honestly don't see how it's possible, but maybe they'll do it.
So the third leg of the stool here is the serologicals, the antibody test here. Michelle, where are we on that? Because that keeps being brought up by governors and others and business leaders even as a key element of getting people back to work. What do we know about the efficacy there?
Right. Well, so that is exactly the issue. People are not wanting to go back out into the public. It's great if everybody's opening up their economies, but if consumers are staying in their house because they're afraid of getting sick, it's not going to actually help any of those economies. And the way that they believe that we'll know that is if people are able to get tested and find out whether or not they have antibodies, whether they've been through the virus and are protected against it. A side note there, though, we still don't know for sure how helpful those antibodies are.
Right.
Or how long they'll last.
Right. So, okay, again, you are incredibly informed on all of this. So when you take all of this in, and I think it's great that there's finally, Operation Warp, and, that we're pulling together all drug makers and just full steam ahead. As someone said to me, this isn't a moonshot. We know how to make vaccines, but nonetheless, there are times. What's your realistic, educated takeaway on this then about kind of when we really get all of this, the right treatments, the right vaccine, and that really enables us, Michelle, to kind of go back to quote unquote normal?
It's such a great question and truly an unanswerable question. I would say this is a moonshot, No, it's never been done before. We've had coronaviruses for decades that we know about. We have no vaccines against them. We don't have a vaccine against HIV. We do have one vaccine against Ebola. We've been working on that for almost a decade, and it took us to get just one. So for them to be able to do this would be astonishing. The same with the testing, the same with the antivirals. That being said, the global pharmaceutical industry is absolutely a powerhouse. If it can be done, I do believe they'll do it. I don't think there's any way that we'll know by January whether or not a vaccine is going to truly help protect people. Right. I also think we don't know whether people will be willing to actually get a vaccine that's not been thoroughly tested.
Totally.
Especially if you're under 65 and not, at super high risk of dying.
Yeah. Totally. All right. Well, an amazing report on, as you say, an unprecedented day. Michelle Cortez, thank you. Health science and medical technology reporter for Bloomberg, joining us on the phone from Denver. Let's get to Bob Boone now. He's got your world and national headlines. Hey, Bob.
Jason, thank you, and I'd like to give you a little bit more information on how this has all evolved today. There is, as you have been discussing, new hope for a COVID-19 treatment. The U.S. Food and Drug Administration reportedly plans to announce the emergency use of an antivirus drug after a trial showed shorter recovery times. According to the New York Times, the FDA plans to announce its emergency authorization as soon as today. Dr. Anthony Fauci, the federal government's leading infectious disease scientist, spoke at the White House today, hailing early trial results for the drug remdesivir.
Whenever you have clear-cut evidence that a drug works, you have an ethical obligation to immediately let the people who are in the placebo group know so that they could have access. And all of the other trials that are taking place now have
Imagine being denied an apartment because of your religion, or your race, or because you have children, or a disability.
It's so wrong. Yes, but who has the power to stop this?
You do. Each of us has the power. The law is on your side. It's illegal for landlords to discriminate because of race, color, religion, sex, national origin, disability, or familial status. If you suspect that you have experienced housing discrimination, file a complaint with HUD immediately so we can investigate it. Fair housing is your right.
Use it.
To learn more, visit HUD.gov/fairhousing. That's HUD.gov/fairhousing. Or call 1-800-669-9777. 1-800-669-9777. A public service message from HUD in partnership with the National Fair Housing Alliance.
Why do hedge funds and other alternative managers rely on Pershing for a highly personalized experience? Mark Alderati, a managing director at BNY Mellon's Pershing and head of Prime Services, explains.
In today's fast-paced environment, where the only constants are change and volatility, you need a prime broker who's both steady and agile, focused on supporting your needs so that you can focus on growing your business and producing results. Exceptional client service and advocating for our clients is at the core of what we do. Our award-winning high-touch team is just one of the benefits of working with BNY Mellon. We help alternative investment managers create great experiences for their clients. Whether it's customized financing, securities lending solutions, platform access, or outsourced trading, BNY Mellon's Pershing is a prime broker who's committed to this business and dedicated to meeting your evolving demands.
To learn more about the unique and industry-leading solutions for hedge funds and other alternative managers, visit Pershing.com. Pershing LLC. Member FINRA, NYSE, SIPC.
The world's... You love TuneIn for live-breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Get your MLB fix with these great podcasts on TuneIn. Fill your seventh inning stretch with the Ringer MLB Show.
I just can't get over it. It's like, Jeter Downs. Didn't realize he was a top. Like, my dad is drinking the Kool-Aid on this. He's like, of course. Mookie was going to leave. I'm like, what do you mean? You don't know that.
Slide into second with the Starting Nine podcast.
Nolan Arenado slides right into the top spot for favorite baseball player. Active in the league right now. It is a pleasure to be sitting next to you, sir.
Thank you, man. I appreciate it. Thank you.
This is, we've been waiting a long time for this. We actually, in terms of active...
Round the Bases with the StatCast podcast.
Ways of going about it. I picked third, so in some ways it made it easier for me Mike, just to go over the first couple of picks, Mike took Barry Bonds, who I think was kind of the obvious guy to take number one, not only.
Catch these and more MLB podcasts right here on TuneIn.
Hey, it's Jacoby here from Jalen and Jacoby. And after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen and Jacoby, The After Show. And we will be joined by the director of the documentary series, Jason Eyre, to discuss each episode in detail. You can hear our After Show right here on ESPN Radio on Sunday nights after the episodes air. And they'll be available on the Jalen and Jacoby podcast feed.
Search Jalen and Jacoby to listen today.
Stay on top of everything happening in the pro wrestling universe with the Body Slamming podcasts on TuneIn. For passionate recaps of the most recent SmackDown to a pro wrestler's perspective on life and culture at large, search sports and scroll down to the world of wrestling to listen. Get your daily dose of NFL shop talk with these great podcasts on TuneIn. Start your morning off right with Around the NFL.
Injured, depleted roster into the playoffs, and I didn't think they belonged in the playoffs.
I think overall, though, it was a great divisional round weekend because you got the first one.
Run into the end zone with the Move the Sticks podcast.
We had a fun little Zoom cocktail hour last night.
Oh, yeah.
What a star-studded affair. Greg, you were there for the earlier part, but it really popped off a little later on. We had Zach Goldman.
And dive deep into the sidelines with the Peter King podcast.
On the occasion of his 50th birthday, come down and record a little bit of retrospective on the life and times of Brett Lorenzo Favre.
That sounds like a bestseller.
It sounds like a precursor to a funeral. That's what it is.
I wasn't thinking that.
Explore these and more hard-hitting NFL podcasts right here on TuneIn.
Want to relive the glory of college football?
Balls over a man, into the end zone,
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship, featuring Clemson and LSU.
There's going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
10, rise to the 5, touchdown! Search classic game replays to listen for free.
If you've used TuneIn much, you probably already know how to favorite your top stations and podcasts for quick access. But did you know you can organize your favorites too? Under your favorites page on the TuneIn app, hold and drag the stations to rearrange the order to your liking. It's that easy.
24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ higher. NASDAQ sharply higher. Loss for the year has narrowed to 0.2%. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks surged from the start today on Google's earnings and news Gilead's virus drug met its primary endpoint. Dow's currently up 600 points. S&P's gained 88, while NASDAQ climbs by 4%. The U.S. 10-year yield at 0.62%. WTI crude futures higher, gained 24%. Gold is little changed, and small caps soar 6%. Leaders to the upside in the Dow, American Express, Boeing, and Visa. Walmart fell 3% and led to the downside. Also after earnings, Boeing rose 6%, MasterCard gained 7%, and GE fell 3%. In other news, Powell said this is now not the top of the federal debt. And wrapping things up, it's a busy night for earnings. Some of the names reporting after the bell tonight include Qualcomm, eBay, Facebook, Microsoft, and Tesla. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. Just drive, baby.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
It is time for the drive to the close. Back with us is Aaron Cannon, co-founder and chief executive officer at Clear Harbor Asset Management. Aaron joining us on the phone from Greenwich, Connecticut. Aaron, good to have you back with us. How are you?
Doing just fine. Thanks for having me back, Carol. I hope you and your family are doing well.
Yeah, I think Jason's family, my family, we're doing okay. We're staying healthy, which is of course the most important thing. Listen, interesting day, and glad to hear you guys are okay. Interesting day. Fed meeting. Heard from Jay Powell. It's constantly economy and virus. They go hand in hand. What are you focusing on? What are you and your team focusing on right now?
Well, I think the Fed chair today made an interesting sort of point, which is that he believes that this challenge will not just be sort of a near-term challenge, but more of a medium-term challenge, which we sort of view as let's say 2 to 3 years. How the duration of this COVID-19 virus plays out, I think, is critically important to markets, to particularly equity markets and credit. And it's, of course, critically important to the directionality of the unemployment picture, which is quite ugly at 26 million and growing. And so we're, very sort of honed in on that. And I think that it's anyone's guess on treatment. Of course, the remdesivir news today is very promising, but it's not a vaccine. And I think the idea that people sort of roll back to work in the very near term without trepidation, and that we wouldn't have perhaps some sort of second curve or some sort of speed bumps along the way towards an improvement post-COVID, I think is foolhardy. I do not expect this recovery to be linear. I think the Fed sort of suggested as much today.
Yeah, it was interesting. I totally agree with you, Aaron, that was certainly what we got from Jay Powell. And I was sort of half kidding earlier in the show when I said, he essentially said in terms of looking forward, the same thing that we're hearing from every CEO as he or she reports earnings, which is we don't know what's going to happen next. And so we just sort of have to take it as it comes. You mentioned unemployment, and I do wonder, as you think about your business and you think about giving investment advice, what are the inputs that you're looking at to try and get your arms around this market and to come up with a strategy that does take into account all these variables, especially around the U.S. economy?
Right. So very quickly, we're first grounded in each one of our clients, their risk tolerance, what the optimal asset allocation looks like. If this isn't the year to have a balanced portfolio, I don't know which year is that year. So not every one of our clients has that for good reason, because they're willing and able to take on more risk for every unit of potential return. But as it pertains to the economy, you're right. It's hard to look at the market and ask, is it a proper discounting mechanism right now? I think the expectation for earnings this year, if the S&P 500 generated, let's say, $164 of earnings last year, there's a lot of talk that this year is about 100. What sort of multiple do you put on that? Or even if you assume, let's say, $130 next year at a 20 times multiple, that's 2,600, and the S&P is over 2,900 right now. So let's move to 2022. Maybe we're not back to 164, but we're at 150, and that at a 20 multiple, which is still a high multiple. We know the 25-year average is probably closer to 15.5, 16. But a 20 times multiple on 150 is 3,000, which is pretty close to where we are right now. So as much as I am very much cheerleading this rally in equities, I'm having a hard time feeling that we're at a point where this is all justified.
So balanced portfolio, so new money, where would you commit it? It's interesting. Let me just backtrack for a second. Our Sarah Ponczak has a great story, Aaron, on the terminal, and just talks about how, small investors, retail investors were running in big time into the market and looking to take advantage of some opportunity, especially when the market sold off. That's over?
Well, we across the board at Clear Harbor, there was a lot of rebalancing going on back in mid to late March, and I can say that and feel proud about that. But if we were to potentially, after this huge retracement, revisit the lows again, well, there's not going to be as much rebalancing going on at the same price point because it already occurred 2-3 weeks ago, right? So, but specific to what are we talking about clients now, particularly as it relates to equities. There are some really interesting trends that have sort of accelerated here. The rise to the cloud, telemedicine, the semiconductor space, and the growth of data centers. Investors looking for streams of revenue that are frankly a little more predictable. The utility segment, the water utility specifically, is an area that is low on the market cap, total market cap spectrum, but some wonderful companies there that we like. If you look at healthcare, certain biotech segments, specific contributors to healthcare more generally, like the human genome, and the ability to sort of have these drugs move into phase 2, phase 3, and into market more quickly. There are specific companies that tackle that. And so we think in the midst of this uncertainty, in the midst of what we think is an elevated equity market, there are plenty of opportunities. On the fixed income side, sure, it's easy to look at low yields and say, why own them? But I think, again, as a hedge against the equity market, what we've realized is the Treasury market is still that hedge. And it's not the high-yield market. High yield smells very much like equity here. Yeah. And I think what we've learned is that trying to sort of create a diversified portfolio of equities and high-yield bonds really hasn't worked and is really somewhat irresponsible. We put high yield into sort of the equity bucket of our asset allocation for that reason.
All right. Well, interesting times to say the least, fast-moving, as you say. Aaron Kennan, co-founder, chief executive officer of Clear Harbor Asset Management, joining us on the phone from Greenwich, Connecticut. It's been a green day on the screen for sure, between the Fed sort of soothing us to some extent and also a huge amount of optimism, maybe about a therapeutic carol. Definitely investors pretty bullish, and some big earnings after the bell coming up.
Yeah, so we'll be breaking them down. Tesla, Microsoft, Facebook, really important, those earnings. We'll get into them after the closing bell. Stick around. We've got the close in just a moment.
Leaders are born. What does it take to get the market?
Get your MLB fix with these great podcasts on TuneIn. Fill your seventh inning stretch with the Ringer MLB Show.
I just can't get over it. It's like, oh, well, Jeter Downs. Didn't realize he was a top. Like, my dad is drinking the Kool-Aid on this. He's like, of course. Mookie was going to leave. I'm like, what do you mean? You don't know that.
Slide into second with the Starting Nine podcast.
Nolan Arenado slides right into the top spot for a favorite baseball player. Active in the league right now. It is a pleasure to be sitting next to you, sir.
Thank you, man. I appreciate it. Thank you.
This is we've been waiting a long time for this. We actually, in terms of like active
round the bases with the Statcast podcast.
Ways of going about it. I picked third, so in some ways it made it easier for me. Mike, just to go over the first couple of picks. Mike took Barry Bonds, who I think was kind of the obvious guy to take number one. Not only
catch these and more MLB podcasts right here on TuneIn.
With millions of podcasts dropping new episodes all the time, how do you keep up with all of your favorites? TuneIn makes it easy. Simply head to the home screen and find the Your New Episode section to see the latest additions.
Hey, it's Jacoby here from Jalen and Jacoby. And after you watch The Last Dance on ESPN, which you're obviously going to do just like the rest of us stuck in our homes in quarantine, you can join Jalen Rose and I for Jalen and Jacoby, The After Show. And we will be joined by the director of the documentary series, Jason Eyre, to discuss each episode in detail. You can hear our After Show right here on ESPN Radio on Sunday nights after the episodes air. And they'll be available on the Jalen and Jacoby podcast feed.
Search Jalen and Jacoby to listen today.
Stay on top of everything happening in the pro wrestling universe with the Body Slamming podcasts on TuneIn. For passionate recaps of the most recent SmackDown to a pro wrestler's perspective on life and culture at large, search sports and scroll down to the world of wrestling to listen. Get your daily dose of NFL shop talk with these great podcasts on TuneIn. Start your morning off right with Around the NFL.
Injured, depleted roster into the playoffs, and I didn't think they belonged in the playoffs.
I think overall, though, it was a great divisional round weekend because you got the first one.
Run into the end zone with the Move the Sticks podcast.
We had a fun little Zoom cocktail hour last night.
Oh, yeah.
What a star-studded affair. Greg, you were there for the earlier part, but it really popped off a little later on. We had Zach Goldman.
And dive deep into the sidelines with the Peter King podcast.
On the occasion of his 50th birthday, come down and record a little bit of retrospective on the life and times of Brett Lorenzo Favre.
That sounds like a bestseller.
It sounds like a precursor to a funeral. That's what it is.
I wasn't thinking that.
Explore these and more hard-hitting NFL podcasts right here on TuneIn.
Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pelleton. Up Wednesday, stock surged. The Dow, the S&P, NASDAQ all rallying. Tommy Gannon, Assistant Supervisor of Facilities, ringing that closing bell all alone at the New York Stock Exchange as we await the latest numbers out of Microsoft, Facebook, and Tesla. But first, this headline from the Bloomberg Professional Service. U.S. virus cases rise 2.7%. That is below the 3% average of the past week. The Dow up 527 points today, up by 2.2%. S&P 500 index up 76. That was a gain today of 2.6%. And NASDAQ up 306. That was a gain of 3.6%. At one point during the trading day, the NASDAQ Composite Index had narrowed its loss for 2020 to about 0.3%. 10-year yield 0.61%. Gold up 0.4%, 17.15 the ounce. And West Texas Intermediate crude surged 24% today to 15.38 the barrel. So stocks rallying to a 7-week high on better than estimated revenue for Google's parent company, along with hopes for a coronavirus treatment. Fed Chair Jay Powell said the coronavirus has brought the economy, quote, to an abrupt halt, and it's uncertain how long the shutdown will last as officials held interest rates near zero. Lindsay Pieggs is chief economist at Stifel Financial. She was our guest here on Bloomberg Business Week, and she told us she does not see a quick rebound for the U.S. economy.
Patterns of consumers have already changed. Right. We're not going to see immediately restaurants refilled, movie theaters refilled. And it's likely that we're unable to reach even a 2% growth rate 12 to 18 months from now.
Google, one of the earnings standouts today, surging 8.7%. Also, word that Lyft is cutting job shares of Lyft, the ride-hailing service, up by 4%. San Francisco rival also rallying today, up by 4.3%. Recapping equities higher with the S&P up by 76 points. That's a gain of 2.7%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Move around. Motion creates emotion.
I feel the earth move under my feet.
You move like they do. I've never seen anyone move that fast.
All right, people, let's move like we've got a purpose.
Company's called Movers and Shakers. They cost a little more, but that name cracked me up.
Bloomberg Business Week, Movers and Shakers, with Carol Mazur and Jason Kelly on Bloomberg Radio.
Yes, indeed. Time to take a look, a little bit of a deeper dive into the markets. Charlie gave you those closing numbers. We had a bullish day when it came to the equity markets. We want to get right to some of the news after the closing bell because this will shape certainly tomorrow's trade. Big tech earnings. Microsoft just crossing the Bloomberg terminal. Third quarter revenue, big beat, $35.02 billion. Estimate was for $33.69 billion. EPS also a beat for the third quarter, $1.40 a share versus $1.14. So certainly a big increase there. And breaking it down into the different business sectors, cloud is always one that we look at specifically. Third quarter intelligent cloud revenue was $12.28 billion. That's a beat. Their third quarter productivity revenue, that was a slight beat. Personal computing computing revenue also a beat. So I don't know, Jason, if you've looked at the stock in the after hours.
Yeah, stock's up just a bit. Let me get latest read. It was up about 1%. Now, yeah, it's up about 1.8% now. Obviously here, more from Microsoft as we go along. But, saying that the COVID-19 outbreak had minimal effect on their revenues thus far. Listen, for a tech name, unless it's really affecting the supply chain or it's really affecting how much and when customers are buying, it's probably not going to impact. And we also know that people are leaning harder and harder on technology for sure. You hear about, Microsoft Teams being one of the things that people use in their work from home, or as you say, work from home WFH home environment.
Just in case you weren't sure. Listen, we're also waiting for Tesla and Facebook earnings. So as soon as they cross, they did say, Microsoft saying more personal computing benefited from increased demand. So definitely seeing some of that play out. And this is going to be interesting. These are the companies that have been driving the market gains. Microsoft is up 12-13% for the year. Do also want to mention Qualcomm crossing.
Yeah, interesting.
Yeah, let's talk about it. Let's go to the outlook, first of all. Third quarter outlook, they're seeing a third quarter adjusted EPS of 60 to 80 cents, quite a range. The estimate out there is for 77 cents a share, says China 5G phone mix stronger than expected. They say their 5G build-outs continuing both in China and the U.S., very important markets, of course, and big markets for them. As for the second quarter, revenue was a beat, and their second quarter adjusted EPS was a beat as well. But again...
Stock's up.
Yeah, stock's up.
Yeah, which is interesting given, especially given that range that they gave for the third quarter. Stock is up markedly, almost 5% now in the aftermarket. So a lot of tech coming out. This is the biggest week for tech earnings. One of the only times, I think the third time in maybe 10 or 15 years, you've had the big five all reporting at the same time. So let's head now to the state of Connecticut. That state's Governor Ned Lamont giving an update.
Just going to go with the first page of this today, the daily summary. Again, it shows a positive trend that we have seen now for over a week. And that means hospitalizations continues to go down, and that the positive cases are 455. Nothing positive about that number, by the way, except that it is a smaller percentage of the number of tests performed. So I think this is all relatively good news in terms of what we're trying to accomplish. And with that, I'd just like to introduce to you my great friend, Rudy Marconi. In the meantime, you can look at the other graphs, which are sort of similar to what you saw before. Rudy, as you know, is our first selectman for life. We all like to hope there in Ridgefield. Does an amazing job there. Been a good friend of mine for a while, and got hit hard by the COVID virus. Some days ago. And I just wanted him to tell a little bit about his story and what we can learn from it as the rest of the state tries to figure out how fast we get back to work. Hey, these social distancing laws are getting kind of tiresome for me. Rudy, tell us what you've learned. It was quite an ordeal.
Sure, Governor. Thank you for having me here today. And I want everyone to understand that the reason for me telling my story is not one of looking or searching for any kind of pity or understanding, but more understanding the virus itself and the devastating consequences that it can have, especially from a health perspective. And I know we're all looking at the economic side of things, and as a capitalistic society, we want to get back to work, we want money to flow again, but I can't stress enough the importance of how this can impact the health of all of our citizens here in Connecticut. And back on April 4th, I came home from a Board of Selectmen's meeting feeling somewhat down and had a head cold. And now, at that point, I went to bed, stayed in bed Thursday and Friday. On Saturday, I was tested, and on April 6th.
All right, you are listening, have been listening to a press conference held by the state of Connecticut's Governor Ned Lamont. He had kicked it over to a colleague of his to talk about his experience. We'll continue to monitor Connecticut, obviously a very important state in their recovery here in the tri-state area.
All right, so let's get to Facebook because we've got a bunch of earnings. Microsoft's up in the after hours. Qualcomm's up in the after hours following their earnings. Facebook is also up in the after hours. So let's get to First quarter revenue, it was a slight beat, $17.74 billion versus the estimate of $17.27 billion. First quarter EPS smack online, or in line, I should say, in terms of what Wall Street was forecasting, and says that it sees 2020 CapEx down from the prior range. That's probably not surprising. Ad revenue, very key when it comes to Facebook. We know everybody has talked about the ad business being hit, whether it's online or whether it's in traditional media. First quarter ad revenue was $17.44 billion. That's a beat. $17.10 billion was what Wall Street was forecasting. Active users, also important. First quarter daily active users, 1.73 billion. That's up from the estimate that was being expected by the analyst committee. 1.68 billion was their consensus. So there you have it.
Stock is up dramatically, almost 7% at this moment. So we have yet to see a tech company, I believe at least today, disappoint. And following on the strength of Alphabet, the parent company of Google yesterday. So a lot of good news, at least coming out of the tech world right now. You have to think if this holds, you may see the NASDAQ actually move into the positive for the year tomorrow once regular trading resumes. In any case, so much going on. We're going to continue to track it and all that and more ahead, including the executive producer of Billions. I'm just going to throw that out there because
I know. You woke up this morning like, I'm going to get out of bed because I know what's coming.
Exactly. This is Bloomberg.
All right, Dave, you're up.
Hi, my name is Dave.
Wilson, where are you? Wilson!
Just what do you think you're doing, Dave?
We're going for a price on Wilson. Open up the door. It's Dave. Who? Dave. Hey, Mr. Wilson!
All right, it's time for a double shot of Dave Wilson on this crazy Fed virus tech earnings day. Dave, let's start with your chart. What are you looking at?
Let's do that. I mean, you're looking at an S&P 500 after today's gain that's up almost 14% for April. And bear in mind, this index fell 12.5% in March as the bear market was establishing itself. So you just don't see this kind of a turnaround from 1 month to the next. In fact, this would only be assuming that, we don't have a decline tomorrow that would wipe it out. You're looking at just the 12th time since World War II that the S&P 500 has risen more than 10% in a month. And there's only been one other time that it fell more than 10% in the preceding month, as it's done this year. And you have to go back to 1974 for that example. Down more than 10% in September of that year, and then in October delivers a double-digit percentage gain. It just shows you how unusual the situation is, almost unprecedented, at least in the post-war period. And if you want to see it all for yourself, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
And Dave, we do want to get to your stock of the day, but I do want to mention Tesla just crossing with their latest earnings. First quarter revenue, $5.99 billion. That is a beat. The estimate out there was for $5.81 billion. So we're seeing that cross the Bloomberg terminal. Just taking a look at some of the other headlines. First quarter adjusted EPS, $1.24 versus a loss of $2.90 expected for the company. Instead, the first quarter, no surprise, Jason, impacted by lower deliveries. Says negative free cash flow at $895 million. The estimate was for a loss of $604.4 there. So watching Tesla here in the aftermarket. Quick check on the stock.
Yeah, the stock is up a touch. I mean, half of 1% and now it's sort of trending downward. Around. So, I mean, let's not forget, we talk about this as a tech company. It's actually a car company. Like, they have to make cars. And the whole manufacturing process, we've seen the back and forth, even that Elon Musk is having with state officials, federal officials, about just getting people back to work.
Can I just remind you that Tesla's still up 91% for the year?
Yeah, you're good. You can. You can. And
it's down noted from its highs, but nonetheless.
All right, Dave, what's your stock of the day?
Sonic Automotive. They sell new and used cars at more than 100 dealerships in 13 states, mostly in the South and West. The company was founded in 1997 by Bruton Smith, who also started the racetrack owner Speedway Motorsports. The 93-year-old Smith is Sonic's chairman. His son David is CEO and vice chairman. Sonic went public also in 1997. The ticker is SAH. The shares peaked at a record in 2002. They made an unsuccessful run at that high late last year, and then this year they plunged as much as 71%. Sonic reached its 2020 low about 6 weeks ago and has been rallying since then. The recovery accelerated today after the release of first quarter results. Sonic's adjusted earnings per share beat analyst average estimate in the Bloomberg survey by the most in more than a decade. Sales surpassed projections as well. The company cited growth at a used car-only unit called Echo Park. Sonic shares jumped as much as 33.5% after the results came out, and they closed with a gain of more than 20%.
All right, interesting, and in line with what we're talking about as it relates to cars. All right, Dave Wilson, thank you so much. We will talk to you tomorrow for your insights, your chart, and your stock. Let's get out to San Francisco now. Mr. Ed Baxter is there with headlines. Hey, Ed.
All right. Hi, Jason. Hey, you know what? Very interesting day because potential significant breakthrough in the fight to aid recovery. And I want to stress that. Aid recovery from the coronavirus. NIH Director Dr. Anthony Fauci says the drug remdesivir seems to really help.
What it is proven is that a drug can block this virus.
He says it shortens the recovery from 15 days to 11 average. Again, not a vaccine, but a treatment. New Jersey Governor Phil Murphy says he'll allow state and county parks and golf courses to reopen May 2nd. New York Governor Andrew Cuomo was on fire at his news briefing today on the subject of no federal funding for states, and Florida Senator Rick Scott lamenting that other areas had to help the big states.
Senator Scott, Florida, you're going to bail us out? You take out $30 billion more every year than you pay in. How dare they? How dare they when those are the facts? How long are you going to play the American people and assume they're stupid? They are not.
He says, who is we and we is who in this country? California Governor Gavin Newsom has announced a program to get 4 days of food for a family directly from farms to food banks.
They have excess produce. They have excess commodities that they simply, in many respects, as perishable items, some of them, they cannot distribute.
He says the numbers on COVID-19 infections still too high to announce any dates on openings. Secretary of State Mike Pompeo says the same problem in China that caused this pandemic is ongoing today.
There are multiple labs that are continuing to conduct work, we think, on contagious pathogens inside of China today. And we don't know if they are operating at a level of security to prevent this from happening again.
So the Trump administration verbal attack on China continues, guys. In San Francisco, I'm Ed Baxter. Jason, Carol?
All right, Ed, thank you so much. And it was, if nothing else, I think Ed said it very well, a fiery presentation from Governor Andrew Cuomo today. He's feeling it.
What did you just say? Who? Cuomo?
Fiery.
Oh, Cuomo?
Yeah. I mean, you heard you heard what Ed said.
I was listening earlier this morning.
Yeah.
Like it's oh, wow. But, it speaks to, states are struggling. But there's also states like New York or California that are crucial to this economy and do put a lot into the federal government more than they take out. And so, states versus the federal government. That's what we're seeing right now.
Well, and it also, I think, does speak to this moment where we are in terms of states being sort of pitted against each other in some ways on the federal level. And clearly you're seeing that from Cuomo. He is responding. Gavin Newsom, the governor of California, not responding quite as much, but Cuomo, fiery to say the least. All right, let's get back to tech earnings because they are certainly driving the trade and the headlines after the close of trading. A big day of tech. Let's put some questions to Bob O'Donnell, president and chief analyst for Technalysis Research, joining us on the phone from Foster City, California, there in Silicon Valley. Bob, great to have you with us. Headlines flying fast and furious as you sit back there in Silicon Valley. What do you make of this? Tech, a lot of enthusiasm here.
Well, obviously there is, and we are seeing great numbers. And as you pointed out just a bit ago, we've yet to see a tech company really disappoint so far. Look, everybody knows the real question is Q2, right?
Sure.
Q1, for the most part, was expected to be reasonably good. And, what's going to be very interesting to watch and differentiate is going to be those companies, and again, you mentioned this briefly, who are providing the infrastructure. So the cloud companies, the companies providing chips, in the case of Microsoft, the companies providing software and services, all of those types of things, I think, obviously have been critically important, but the emphasis of their importance just continues to grow. So it will certainly be interesting to see how those companies do over time.
Right.
Luckily, then you got to dig into diversification issues, and Microsoft is well diversified, in that particular case. Sorry, go ahead, Jason.
Bob, no, we apologize. We just have to head to Washington for a moment. If you can hold on. President Trump participating in a roundtable with industry execs on the plan for opening up America again. They're there in the state dining room. Let's listen in. This was from earlier today.
Better than ever before, and that's what we're seeing. We're seeing tremendous pent-up demand, and it's a beautiful thing to see. So it's wonderful to have America industry leaders, and that's what you are, true leaders, to the White House. You've been here before, all of you, and we've talked about it in different times. We built the greatest economy in the history of the world, and nobody even disputes that. And one day they walk in, they say, sir, we're going to have to close it up until we get rid of this hidden enemy, this terrible scourge. And that's what we did. And we did the right thing. We did an incredible job. We worked with the governments. We worked with states all over the country. We had no ventilators, or very few, from previous administrations. And we became the king of ventilators. We have thousands and thousands of ventilators. We're now helping other countries with ventilators. We had old-fashioned tests that didn't work. They were really obsolete. They didn't work. They were broken. And we end up, the testing has been incredible now, and to a level that nobody's seen. I got a call from President Moon of South Korea. He said, congratulations, your testing was just, nobody's ever seen anything like we're doing. We've tested more than all countries put together, and millions of tests, and the highest quality test. But it's great to be with you. We're joined by Matt Maddox of Wynn Resorts, Chris Reynolds of Toyota, Chris Nacetta of Hilton, Josh Bolton of the Business Roundtable, Walt Immer of Waffle House, and thanks to Vice President Mike Pence, Secretary Steve Mnuchin, and Secretary Eugene Scalia. That Scalia has very good genes. Where's Scalia? He has very good genes, that guy, I'll tell you. Scalia, he's got the Scalia genes, right? We all know what that means. We mourn, and I have to say this so strongly, we mourn every life tragically lost to the invisible enemy, and we're heartened that the worst of the pain and suffering is going to be behind us. We think we really have crossed a big boundary, and much better days are ahead. And I often say I see the light at the end of the tunnel very strongly. This demand is going to be incredible. I think next year is going to be an incredible year for our economy. I think the fourth quarter is going to be really, really good. Kevin, we were talking about that before. You maybe will say something. And we're going to be in a transition quarter next quarter, the third quarter. And I think we'll do very, very nicely there from an economic standpoint. But thanks to the devotion of the American people, the number of new cases continues to decline. The United States has now conducted nearly 6 million tests, far more than any other nation, as I said. So many tests, and so much has been learned about what we're fighting. And if it does rear up a little bit in the fall, or even a lot, we'll be able to put it out. We'll put out the embers, or we'll put out the flames. 2 weeks ago, we released guidelines to give states a real strong indication of what we want and how we want it done. We've really had a good relationship with the states. Mike Pence has worked very, very hard with the task force. He's headed the task force, so importantly, with a great group of people. And it's just been incredible what's taken place over a very short period of time, including the gowns and all of the surgical equipment and The safety equipment and masks. People don't talk about masks anymore. That's the other thing. They're not talking about masks. They were talking about where are the masks, because we had a cupboard that was bare. We didn't have a lot of equipment or medical supplies in the cupboard that we inherited. Now we're taking in millions and millions of masks. I'll give you a number that you won't even believe we have an order. 500 million masks coming in. And we've delivered millions and millions and tens of millions of masks all over. So you don't hear about that anymore either. You don't hear about ventilators. You don't hear about masks. And you shouldn't be hearing about testing, but that's the last thing they can complain about, I guess. You know, if we do 2 million tests, they said, how come you didn't do 3? Well, we do 3, and then they say, how come you didn't do 4? That's like a dream for the media. But we've done incredible with testing, and you'll see over the next coming weeks. Mike, you may want to speak about that a little bit, but over the next coming weeks, you'll see some astonishing numbers. I don't know that all of that's even necessary. You have some governors that love the tests. You have others that like doing it a different way, an old-fashioned way, with some testing, but we're going maximum testing. We've encouraged the more than 30 states that have taken steps to resume economic activity already. We've given them tremendous encouragement and support. We're backing them 100%. You know, many governors have called me, telling me their plans, laying them out. Governor of Texas, Oklahoma, governor of Arkansas, many, many governors. I spoke with Governor Cuomo. We had a great talk today on a different subject, but he wants to get open. Everybody wants to get open. They want to get open, and they want to get back to business. And their constituents, the citizens of this country, want to get back. And that's what's happening. So I just want to perhaps start off by introducing our vice president, and then we'll go around the table, and you'll introduce yourself and say a few words to the media. You're covered by a very serious media out here. The audience can't see it, but these are the most wonderful human beings. Actually, this is a nice group. I can't imagine. We actually have a nice group of people. But, Mike, if you could say a few words, please, that would be great, and then we'll go around the table. Thank you.
Well, thank you, Mr. President. And I want to thank all the distinguished business leaders who are here and the literally millions of Americans that are employed at the businesses represented around this table. It's remarkable to think, Mr. President, that before the coronavirus epidemic came ashore, we had seen extraordinary growth in the American economy, not just the stock market setting records, millions of new jobs, more Americans working than ever before. But in January, when you stood up the White House Coronavirus Task Force, you said we had one mission, and that was to save lives and to make sure that the healthcare providers in America would be able to render the level of care to any American struggling with the coronavirus that we would want our own family members to have. And thanks to your leadership, thanks to the partnership that we forged with states across the country, working with local health officials, Mr. President, as you said yesterday, we have light at the end of the tunnel. We really are encouraged by the progress in even the hot spots around the country. Cases are leveling off, and in some areas going down. Hospitalizations are declining, even in the greater New York City area. That's a testament to the American people, and to the way the American people now nearly 45 days ago embraced the guidelines to slow the spread. And as we come to the end of this mitigation period, states across the country have all embraced those same mitigation and social distancing efforts. The American people have put them into practice. We've saved lives. We've protected the vulnerable. We've preserved our healthcare system, and we're well on our way to healing our land. As you mentioned, testing will be a part of how we move to the next stage. It was just on the 16th that you laid out a plan for opening up America again. And as we sit here today, I'm informed that 35 states have already released formal opening plans, many of which are consulting directly with our team here in the administration, and we're going to continue to work with all of them. Testing is a major part of it, and I can assure you, Mr. President, and the American people, that we'll continue to scale testing across the country. We're doing more than 1 million tests a week now, 5.8 million tests total. We expect by next month very quickly to be at a capacity to do more than 2 million tests a week. We laid out our blueprint for testing, and as I heard again today on a conference call with America's governors in agricultural states, there's great enthusiasm for the blueprint for testing that you unveiled earlier this week, and we'll be surging supplies and resources and reagents into the states to support that increased testing. But we know that ultimately we've got to find a way to help America get back to work, and having the opportunity to hear from these business leaders about best practices that businesses are considering, whether they be restaurants like Waffle House or major corporations and hotels. We welcome that. We look forward to partnering with you, as the President said. America works when America's working, and we're absolutely committed, as soon as it is safe and responsible to do so, to partner with governors across the country, partner with businesses across the country, and open up America again. So thank you, Mr. President.
Thank you very much, Mike. And just before we go around, Puritan Medical Supplies, a wonderful company, will produce 40 million additional swabs per month starting in May. Now, they've opened up a very big process, and that was funding authorized by the Defense Production Act. So that'll help the states. And again, we're there to help the states. A lot of states can buy their own swabs. It's not that big a deal, but we're here to help them. We want them to be successful. We had, as you know, the governor of Louisiana in today, and we told that story, which has been a really great story. And we had the governor of Florida in yesterday, and that was a great story. These were just incredible what's been happening. So maybe we'll start with my left. And Chris, you want to take it and tell them about you? I know a lot about your company, but maybe a lot of people don't.
All right.
Go ahead.
Listening. Sorry, we both jumped the gun.
I didn't know what the arm extension. It felt like a point.
Sometimes we read our cues really well. Actually, most of the time. Of course, President Trump, and I did want to correct myself, it was not a playback. This is happening live. So we will continue to monitor the president and the team of CEOs that are around that table. Of course, it's all about getting America back to work, reopening the economy. So we'll continue to monitor some of the headlines as they come out of that.
Well, especially if some of those headlines have to do with the CEO of Waffle House.
I know.
We both
like
about
perked
Waffle
up.
House yesterday, I believe. At the moment, the group is hearing from Chris Nassetta, who's been a guest on this program, CEO of Hilton. So eager to see what comes out of that. In the meantime, let's get some headlines on a very busy period of headlines after the close from Charlie Pellet. Hey, Charlie.
I thank you very much, Jason Kelly, but you know what I'm going to say. That's what we do here at Bloomberg. We got you covered on earnings. Tesla's first quarter revenue, $5.99 billion. Estimates, $5.81 billion. Shares surging after hours, up now by 10%. Facebook reporting an 18% increase in first quarter revenue, showing ad demand was strong before the COVID-19 pandemic hit marketing budgets. Shares are jumping now by 10%. Facebook higher after hours. Qualcomm, biggest maker of chips for smartphones, gave a solid sales forecast for the current quarter, saying the COVID-19 pandemic has reduced global demand for the devices, but its outlook remains positive. Microsoft said quarterly sales and profit rose, lifted by demand for internet-based software and cloud services. Also, eBay, its first quarter net revenue beat estimates. It was an up day on Wall Street with the Dow, the S&P, and NASDAQ all advancing today. S&P up 76, a gain of 2.7%. The Dow up 532, up 2.2%. NASDAQ up 306 points. For NASDAQ, that was a gain of 3.6%. And should mention that during the trading session, NASDAQ lowered its year-to-date loss to just about 0.3%. It was also a Fed Wednesday. Fed Chair Jay Powell talking about coronavirus and the state of the economy as well as the outlook. His remarks were live right here on Bloomberg Radio.
Manufacturing output fell sharply in March and is likely to drop even more rapidly this month, as many factories have temporarily closed. Overall, economic activity will likely drop at an unprecedented rate in the second quarter.
Gilead Sciences helped drive stocks higher today. It reported the trial of its remdesivir treatment for the coronavirus, quote, met its primary endpoint. Gilead shares surged today by 5.7%. Airlines being subsidized to serve the most remote American airports can receive partial payments even if they cut flights during the new coronavirus epidemic. Under a plan announced today by the government, shares of most of the airlines did advance today. In fact, UAL, parent of United, surged 12.1%. 1%. American Airlines Group also up 12.1%. Delta up 12.2%, while Southwest was up by 4.3%. 10-year yield 0.62%. Gold up 0.4. West Texas Intermediate crude surged 24% today, $15.29 a barrel. Recapping, S&P up 76, up 2.7%. I'm Charlie Pelleton. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, let's get back to our conversation with Bob O'Donnell, President, Chief Analyst at Technalysis Research, on the phone from Foster City, California. Very grateful to him for sticking around as we're jumping around all over the place. Bob, thank you so much. So sure. I believe when we left off, you were talking about the importance of Q2 here. As you look at, and let's just stay with Microsoft and Facebook for a minute, as you look at what they're saying about Q2, what do you see?
Well, for Microsoft, it's clear that they're very well positioned, because what I was starting to talk about was the infrastructure.
Yes.
And companies who are doing infrastructure are going to survive this just fine. And oh, by the way, obviously are even going to grow, because we've seen more and more dependence on cloud-based services. To Facebook, it was actually very interesting to see there were some serious doubters going into these earnings about whether or not Facebook could deliver. Of course, there were questions yesterday because of what Alphabet's Google parent had said about advertising revenue slowing down, and Facebook did acknowledge some of that, but yet they also said that first part of April seemed to be back to year-on-year types of numbers. So that is an encouraging sign. The real question everybody's going to have, of course, is how do people's behaviors change once our lives start to change back again? What of the habits that we've picked up while we've been sheltering in place will continue, and how much of those are going to be dependent upon tech-related companies? I think it's clear that they are going to continue to grow. Certain areas are going to fall back. My guess is we'll be using Facebook and some other things less, but cloud-based service in general is going to be strong, and I think that's what drives companies like Alphabet, Microsoft, Amazon moving forward.
Yeah, I think any of those big players, right, Bob, in the cloud space, because if anything, all right, maybe we're all not going to continue working at home like we have been, or constantly doing, Zoom chats with family and friends, or, fitness classes online. But this has definitely, or telemedicine, although I think what this has shown us is how easy you can do it, and it actually works really, really well. So a good percentage of that has got to stick around.
I absolutely think so. And, and what we're also seeing is an emphasis on connectivity. We were talking a little bit about Qualcomm. I mean, Qualcomm had, very impressive numbers. And despite their concern that overall smartphone shipments are going to go down, they're driving a lot of the 5G movement. And I think people recognize that the importance of having good quality connectivity is going to be essential moving forward. So I think that's a good sign for them. It's a good sign potentially for some of the big carriers as well, as we think about the infrastructure, how well it's done. I mean, think how well our networks have done it. If they didn't survive as well as they had during all of this, it would be so much worse for all of us. So absolutely, Carol, I think, those things that can provide the connections that we need, that can provide the services that we need, and getting people to kind of finally make the jump over to going digital completely, to ordering things online. Let's not forget, not everybody does that or had done that until now. All of a sudden now everybody's doing that. That's a behavioral change that I think has long-term impact.
Well, it was interesting. We had a conversation yesterday, Bob, with Max Levchin, a name very familiar to you, a guy familiar to you for sure, just talking about what he's seeing at a firm, and obviously having founded PayPal and had his hand in so many other things, Yelp and others, just seeing people's behavior. I do wonder, given your deep expertise and knowledge in all things Silicon Valley and tech, how do these companies change to some extent? Because at the same time, we're talking about Google, Alphabet yesterday saying, it could be a couple months before employees come back, they're working remotely, et cetera. What's the sort of cultural shift underneath, and does it ultimately manifest in a way that changes these companies?
It's a great question, Jason. I mean, I think what we're going to see is a number of things. First of all, I think there is going to be a recognition that work from home does work for some people, and we're going to see a lot more of that. So that some of the things that have happened of people, buying new PCs and setting up home offices in a more serious way is going to be important, because even when people go back, they're going to not all go back at once. I think hopefully this will finally kill the open office, right? The thing that everybody hates anyway, because you're not going to want to have a whole bunch of people sitting on top of each other. And that'll be an interesting development across, industries. But fundamentally, I think what we're seeing is a recognition that there are indeed new ways to do things. And some of the Silicon Valley promises that have been discussed really came to life. And I think those are the kind of long-term impacts. They're going to move the market and our society, frankly, even more towards a tech dependence.
Right. I think about how Tesla really pushed the whole idea of EVs in a big way. And I do think the virus is going to push online, whether it's working or telemedicine or what have you, in a big way, because it's just because of what has happened.
Totally. All right. Our thanks to Bob O'Donnell, President, Chief Analyst at Technalysis Research, on the phone from Foster City, California. We didn't get a chance to talk about Notre Dame football, but I know he's hoping that is back in the fall in some form or fashion, too. All right. Let's stay out on the West Coast for the moment. Ed Baxter is there in San Francisco with world and national headlines. Hey, Ed.
Yeah, I know Bob very well. He's missing the Giants as well, guys. At a business roundtable at the White House, Vice President Mike Pence is painting a more optimistic picture now of the country.
We have light at the end of the tunnel. We really are encouraged by the progress in even the hot spots around the country. Cases are leveling off, and in some areas going down. Hospitalizations are declining.
He says 35 states now have plans for reopening. Potential first step in the intervention of how new coronavirus attacks the human body. NIH Director Anthony Fauci says the drug remdesivir is now in some clinical proof of efficacy.
The data shows that remdesivir has a clear-cut, significant positive effect in diminishing the time to recovery.
So not a vaccine, but intervention. In New York, Governor Andrew Cuomo firing out against the thought that the federal aid could be withheld from the state. Response to Florida Senator Rick Perry saying that, Rick Scott, I should say, saying that federal funds should not be shared.
They're not bailing us out. We bail them out every year. New York State pays $29 billion into that federal pot, $29 billion more every year.
And he says while numbers of cases are down, not significantly enough to open back up. In San Francisco, I'm Ed Baxter. Jason, Carol?
Ed Baxter, thank you so much. I want to bring you one headline on this busy news day. Exxon coming out and saying that they will maintain their dividend, which is welcome news, I think, to a lot of investors who have seen dividends and buybacks essentially brought to a halt. A lot of companies canceling their dividends. It'll be interesting to see what investor reaction is there, and maybe even some regulatory reaction, although obviously Exxon not getting a bailout by any by all accounts, right?
Well, the stock, it's up about 0.9% in the after hours, perhaps on that. And keep in mind, some of these energy names have been so beaten up. It's up about 30. It's down about 32% this year. But those dividends, when you invest in these energy names, that's a big part of the investment story. They have an over 7% dividend, so that's substantial. So if you're an investor, you've been beaten up just on the share price. At least you say, okay, but we've got the dividend,
right?
And so that has to go into their calculation when they think about this. All right, let's get to our next guest.
Absolutely. Tracy Brown, President and CEO of the American Diabetes Association, joining us on the phone from Arlington, Virginia. And Tracy, first of all, thank you so much for joining us.
Yes, Jason and Carol, thank you for having me.
Well, we are excited to talk to you in part because, you are very much on the front lines of this, and you are dealing with an issue that Carol and I have been talking about a lot, which is the disproportionate effect this disease is having on folks with underlying conditions, with folks in communities of color, economically disadvantaged people. Tell us what you are seeing. What do we need to know that maybe we're missing beyond those sort of broad strokes?
So, Jason, I think you have hit the nail on the head here. This COVID-19 pandemic has really shined a light on some existing problems in a very large way. You talk about people with underlying conditions. That's 133 million Americans living with some kind of underlying condition. When you think about diabetes specifically, you are talking about 34 million people who are diagnosed with diabetes, 88 million who are diagnosed with prediabetes. I'm one of these people living with diabetes and have been thriving while living with this disease for 16 years. But here's the issue. I think you've heard that for anyone who contracts COVID-19 that has an underlying condition, the higher rate of having a poor outcome is what's happening. This is demonstrated by data that is coming out across the states, that out of the deaths that have occurred with COVID-19 right now, there is the upwards of, in many states, 40% or more, Jason, those people have had diabetes. When you double down on that and then you start to look at the numbers as it relates to people of color, you're talking to the upwards of 70 to 75% in some of these states that the deaths of coronavirus are people of color. This is a real issue that is affecting all of America right now in this crisis.
And this goes to a bigger conversation, too, that we had earlier in the week that talked about, Tracy, unfortunately, the level of health care that you get is often contingent on the job you get. And the job you get is contingent on the education you get. And the educational access that you have is often, courtesy of the world that you are born into. And we know that minority groups are often left behind when it comes to that initial kind of gateway into a much better life. And so this is a big problem. How do we get at the core of it?
So, Carol, what you just articulated is the social determinants of health, right? Like these are all of the environmental factors that affect people, and particularly diabetes and, again, other underlying conditions. And if you think about these social determinants of health, there's data out there that says that equates to about 80% of poor health outcomes. Now, let's overlay, we already had an issue pre-COVID, as you have just outlined. Let's add on top of this the COVID-19 crisis. With more than 26 million people or more now filing for unemployment, the majority of those people, when you lose your job, you lose your insurance. When you lose your job, not only do you lose your insurance, you lose your income. Let me put the spotlight on this as it relates to someone who is living with diabetes. The person living with diabetes already has medical expenses that are 2.3 times more than a person who does not have diabetes. We already know that lots of data out there that says people who don't have insurance have poorer health outcomes. And then now we have that if you have diabetes or an underlying condition, the likelihood of COVID-19 leading to worse outcomes and or death, all of this now has just gotten, exponential. And so what you have, Carol, now is the people who need help the most are not getting the help. And if you don't have health insurance and you don't have income, you can't get the medication that you need. If you don't have health insurance, you will not go to the doctor to care for your body, which means you can get sick and sicker and then end up in the very hospital system that is already exploding right now. It's a bad scenario.
Right. It's a cycle that just continues going down. So, Tracy, talk to us about what you are pitching lawmakers, regulators on to alleviate some of these problems in the short term, and then maybe we can talk about some of the more structural issues, because I know the cost of insulin and the ability to get insulin is a hugely important issue for folks with diabetes.
Exactly. So, Jason, there are, three things that right now we are beating the drum very hard on during this COVID-19 pandemic. The first is, as you talk about, but the last thing that we want is for people not to take their diabetes medication, whether that's insulin or other prescription drugs. And so what we're asking, both at the federal and the state level, is an elimination of all copays for insulin and other diabetes prescription drugs. So that's not the end-all, be-all, Jason, but removing as much of the financial burden as we can so that people do not skip or ration their medication right now is what we're going for. So that's one. Two, we've talked about the need for continuity of health insurance coverage. This is huge. So we are actually speaking and advocating very hard to say, look, if Americans with diabetes lose their job during the wake of this pandemic, we want to make sure that they don't lose their health insurance coverage, and so that there is continuity of coverage so that they can still get the care that they need. And then the third thing, Jason, look, the numbers with COVID-19 cases still continue to rise. We know the economic pressures and that states are looking at reopening. We have to have not only more testing, Jason, but the testing has to get to the communities and the people who are most at risk and need it. So we are advocating very hard, not just more tests anywhere, everywhere, but let's get the tests to the communities that we need it, because we know right now that's not happening.
Tracy, and I will say within my family, like I know a couple of people who have diabetes, I will say also, I think once we get through this, and you're right, we need to make sure that those who have diabetes are getting their treatments. It's crucial. But I do also wonder, take several steps back. We've got to figure out how to get diabetes under control. And I'm a big proponent. Jason and I talk about it a lot with guests on our show, doctors and, people from the medical community about really focusing, and this is a shift for healthcare, is focusing on wellness. And maybe this is something where telemedicine can help us in the future, because it makes it easier for everybody to reach out potentially to the medical community. But, that we have such high numbers in the United States globally when it comes to diabetes, we've got to figure out how to roll back those numbers. I mean, and so I'm curious about your efforts along those lines.
Well, Carol, I couldn't have said that better myself. Listen, the diabetes is an epidemic that existed before this pandemic existed. And here's what we know. 85 to 95% of people are walking around this country and they don't even know that they actually have prediabetes. And I told you 1 out of 2 people have prediabetes or diabetes. What we have to start with is driving awareness. And so we are trying to drive home a simple notion, Carol. Every time people go to the doctors, you get your blood pressure checked. It's just like clockwork. That is not the same for your A1C. So I don't, I'd even ask you, do you even know what your A1C is, right? This should be a standardized, very standardized check that happens every single time that someone goes to a doctor, a clinic, a health fair, or whatever, because it starts with knowing. Then once you know where you are with diabetes or prediabetes, this is the thing that unnerves me.
Right.
There is a lot of things that you can do to help manage your diabetes. And here are the 4 things, Carol. 1, you have to be mindful of what you're eating. You have to be mindful of how you're moving, your exercise. You must manage how you're sleeping, and you must manage your stress. All of these things cause havoc to your blood glucose or your blood sugar if not managed. So that's for a type 2, someone living with type 2 diabetes, if you can do those things, you can start to get your diabetes under control.
Right.
For those who live with type 1, which is an autoimmune disease, listen, this is where insulin affordability becomes a must, because we don't want people who need insulin to live choosing, do I pay my rent or do I get my insulin? Do I put food on my table or do I get my insulin? So that's the other thing that we're fighting for too, Carol, but you're right. Like, we need to control the things that we can control, but it all starts with knowing.
Right. So, Tracy, I do wonder, given your background, you've had some big corporate positions. You were the Senior Vice President of Operations and the Chief Experience Officer at Sam's Club. It's part of Walmart, as our listeners very well know, being the savvy business audience they are. Where does the responsibility lie, and where do you see the most effort on that side, on the wellness side, especially between the government and companies? I mean, I know, we're very fortunate to work for a company that puts that front and center, but I know we can't say that for all companies. What do you hear from the corporate side, especially at this time when people are going to have to start to be much more worried about the health and safety of employees?
Yeah, I mean, Jason, I think the responsibility, all of us bear some responsibility in this entire ecosystem, from federal government to corporate government to state, local, community to, even the insulin manufacturers, the drug manufacturers, the retailers, pharmacies, everyone, including the individual. We all own a piece of this responsibility. And just as you said, when I am talking to corporations, and again, someone who spent a lot of time at Walmart, these corporations care about their employees. At least I know for a fact Walmart does. And they want healthy employees. But if you didn't care just about the human side of this, there's an economic side of this as well, Jason. Diabetes costs this country $327 billion a year. So there's both a human piece of this and a economic piece of this. And I think right now, all of these corporations, they not only have the employees, their own employees, but the communities in which they're located.
Right. And I will, and we're running out of time, but I will say too, Tracy, I mean, you're right. It's economic. I mean, in terms of healthier food and having access to it, it can be more expensive, or you have to have the time to prepare it. So there are so many things that go into this, but I'm so glad we got some time with you. Good luck with your efforts. Tracy Brown, President and Chief Executive Officer at the American Diabetes Association, joining us on the phone from Arlington, Virginia. I have to say, when we talk about health crises, and of course nothing compares to, I think, what we're going through, but I do feel like diabetes is another one, Jason, that we've got to figure out.
Absolutely. Oh, yeah, for sure.